always come back to collectibles. It's somewhat cyclical. But in terms of the coin collectibles, they don't, unlike the baseball cards and things like that, they don't tend to lose their value over time if you look at the charts. They tend to do very well. And it tends to be a nice, slow, and steady appreciation for those collectible coins. We have more information on this on our website. If you subscribe to our website and utilize our Gold Silver Pros University, we have a whole article on this with the charts and talking about how to get into it. But definitely, if you're past just buying a few pieces of bullion and you want to expand out, the numismatics are available a lot of times, even when you have shortage of the bullion, and they can be a really good market to get into.
And that's mainly for gold, correct? Or is it also for silver?
It can also be for silver. So if you have a really rare silver coin that's graded well, those coins can do very, very well. And the one thing about those collectibles is, say you have a work of art. A work of art could be very cyclical because it's all of the value in art is in the eye of the beholder. It's different for coins made of gold and silver. The lowest value you're ever going to get is the melt value, right? So you're going to retain your value in the coin. But the value that you get for the historical significance, the quality of the coin, the demand that's in that market is where you're going to get that additional value. And again, a lot of times I see people gambling in the stock market or buying cryptos, or buying an expensive sports car. And I'm like, I would rather buy a numismatic coin. Right now, I would not go buy a share of Tesla. I would buy a numismatic coin before I would do that. I wouldn't buy Bitcoin because I've seen it crash 80% in a day. In fact, it did that last year. I believe it was 80% last spring when we had the big market pullback after the pandemic was announced here in the western part of the world. And Bitcoin, a lot of the crypto complex just went. It just crashed. The numismatic coins did not. They held their value very, very strongly. And I think there's a lot more safety in them than people give credit for. And I think the easiest way to validate that, Elijah, is just look at the price charts. There are price charts out there, and there are books out there that help you understand their value, and you'll see they're much less volatile than a lot of other speculative assets that people get into every day and accept as normal. Look at your 401k. When I was in the Janus funds in 2000, the tech crisis, I lost 40% in the span of a month. And then I got out of all those funds. I sold at a 40% loss because I'm like, I'm not losing anymore, and they continue to go down. I've never seen anything in my numismatic coin collection do that over the 12 years that I've been investing in them. So I'm sorry, I'll take numismatic coins over the general stock market and over the cryptos.
I think that's a really good point. How, there can also kind of be cycles, right? And if you catch the wave, then that can be a very good asset to hold. But at the same time, as you mentioned, it's important to be an expert in that because there's a lot of scams out there, and you don't want to be caught in one of those. So, but Robert, thank you so much for your time today. If our viewers would like to hear more of these interviews, they can hit the subscribe button and the bell icon, so they'll be notified of all the new interviews coming out. If people would like to find you, where can they find you online?
You can find me at goldsilverpros.com. You can email me at robert@goldsilverpros. You can find me at Twitter and on YouTube under Gold Silver Pros.
Robert, any last thoughts you'd like to add?
No, just educate yourself on the market. Understand market dynamics. We teach cycle trading. Definitely educate yourself. We have free resources on the website. I know Miles Franklin does a lot of this as well. And just educate yourself on the market and invest in things that you feel are safe and protect your wealth over the long term.
Fantastic. Once again, thank you so much for your time, and God bless.
Thank you.
Physical silver and gold in your hands. Personal service, competitive prices, and zero complaints. That's Miles Franklin. Call us at 1-800-822-8080 or email us at info@milesfranklin.com.
Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics, and I believe we are now queued up and going live as I am joined by my dear friend Kai Hoffman of SOAR Financial, who is joining me today to talk about silver, the markets. We'll see if Kai can figure out anything that the Federal Reserve could say that wouldn't be net bullish for silver, but Kai, great to have you here, sir. How are you today?
Chris, it's good to see you again. And it's been a while since I've been on your channel, so it's great to catch up. Good timing, as you mentioned. Jerome Powell is supposed to speak today. It's Wednesday, so we got the FOMC meeting concluding. So I'm looking forward to hearing what he has to say, although I kind of expect nothing. So
yeah, well, I'm going to put my ounce on you being able to peg the general gist of whatever they're going to do. I think you can call it blind before it happens. And we will dig into that. Also, silver, which is spoofed down 21 cents on the day. Quite a volatile day, which I guess would make sense as the Fed is out doing their thing. Although, Kai, as we start to dig into, before I realized the final push record button had not been hit, today's episode brought to you by Defiant Silver Core that had some drill results out. Here, Defiant Silver is pleased to provide an update on the ongoing drill program, including a newly discovered zone of mineralization. And down here, we see intersected high-grade silver, including 1.57 meters of 1,340 grams per ton silver equivalent. And Kai, for people who are new to reading a drill result, can you help explain in just layman's terms what that's saying and what they would take away? And when you're analyzing the projects, what you would take from that?
Yeah, a couple of things, right? So we're 1.3 kilograms of silver equivalent is fantastic, but that also means there's usually other metals in there, usually zinc, lead. So got to take a look at that. One thing I look, of course, is the interval width. Like one thing, 18.55 meters of 149 grams is actually not bad at all. It's got a high grade component to it, which makes payability easier. And you got to look, of course, if it's mineable. It's from 241 meters, so that definitely sounds mineable. It's a new zone, so can they connect it with the old zone? That's something I look at when I see those drill results, and it looks pretty good. Market seems to be reacting positive. I think the stock is up 4%, so they seem to think that this has a positive impact on Defiance and their project moving forward. So, and of course, I see the word Veta Grande in there. That's something people always try to chase there in Mexico. That's the big mother lode, the big mother vein, and Veta Grande is the big vein in Spanish. So it seems like they're getting close to it and are hitting it with their high-grade intercepts there of 1.3 kilos over 1.55 meters.
Yeah, and it'll be fun to follow along. I mean, I'm of the school of thought, as you well know, that silver is going to go up. And, you know, I don't, that's why it's nice having folks like you on the show who are really experts at a level I'm aspiring and dreaming to do one day of knowing these credits. Although, Kai, would you say that for people, if they're, you know, if they find at least management teams that they think have their head on their shoulders, the right experience, know what they're doing, good share structure where the right incentives are in place, you know, maybe getting a good mix of the projects you like that resonate with you, don't expect to hit, you know, 20 out of 20, but, you know, if you have some producers and then you have a couple explorers, and if you hit one or two of those, then is that a good way to approach this?
Oh, most definitely. Like, as you all know, and I'm not saying anything new, mining is a high risk sector. It's like biotech to a degree, if people want to compare it, right? You got to go through different phases, approvals, studies. And of course, Mother Earth has to contain some metal that you can actually mine, right? But you never know until you drill. So there's drill risk. So diversifying producers, developers, and then junior exploration or earlier stage makes a lot of sense. And it's usually the junior explorers that might outperform in your portfolio, but the other ones are there to secure wealth and ideally grow it, especially in a rising silver price environment or gold price environment for that matter.
Well, that makes a lot of sense. And speaking of a growing silver price environment, let us not, you know, delay the action. You can't, it's the wrong one. Although, what are they doing? SEC delays decision on approving Bitcoin ETF. Okay. Well, I hear Gary Gensler's in charge now. Maybe there'll be a new silver ETF soon to add to the great ones already out there. But here we go. What investors should expect to hear from the Federal Reserve on Wednesday? Kai, do you want to start first, or should I read a bullet point so you can make funny comments on it? How would you like to play this, sir?
Well, it's like, to be honest, like, I don't expect anything from the Fed today. They made comments already that they probably won't be raising rates until 2023. So the inflation is at 2.6%. Bond yields are 1.55 last time I checked, so it might be just around there. They don't have anything to do or say today. So it's going to be a big nothing burger, and people are going to probably get hung up on one single word, whatever Jerome Powell says. But it's not going to have a big impact. He's more or less going to reiterate that they're not going to raise rates in the next 12, 18 months for sure. He's not going to be as clear about that as I just was, but that's exactly what I'm expecting to come out of this meeting. And it's not going to make a big difference to gold and silver, unfortunately. Long term, of course, but the short term, I don't think it's going to have a big impact. I think this is a big nothing burger today.
Yeah, and when you said not raising rates, but sometime in April 23 or April 2027, maybe as well as 2080, would you? I think you said 2023. Would you take the over or the under on that, sir?
Oh, that's a good question. I think 23 sounds quite realistic, to be honest. Mid year 23, so April 23. We'll see what the numbers. We have COVID as well. That's the wild card, right? So, what does the pandemic do to everything? If the pandemic stays around until the end of this year, maybe even next year, then it could be even delayed. So, with COVID, but the U.S. is different. The U.S. is doing a great job on the vaccinations in comparison to other countries like Canada and Germany. So that could have an impact. So it could be earlier, but that all depends on vax rates and overall COVID numbers.
Well, I'll leave an offer on the over on that one. I don't think they're going to raise before 2023.
No, it's like it doesn't feel like it. But again, there's that wild card that you never know. Like they're hyping economic data right now over across all channels, which just makes me laugh because we're coming from a very weak year. When you tell me that, like Canada, for example, as well.
Kai, excuse me, and apologize for my rude manners and interrupting. I just didn't want. I'm trying to protect my guests. And obviously, Mark Zandi, the great of Moody's. Now, I work there, so I can tell some stories about Moody's if necessary. But the economy is busting out all over. It's like they're calling the Ghostbusters or the Stopbusters that Deutsche Bank had when they smashed the silver price. But it's busting out all over. So I know it's like New York is the haven of economic analysis, so it takes a while for the real stuff to flow out to Canada. But so everyone, do you disagree with Mark Zandi of Moody's that the economy is busting out all over?
No, I don't agree. Actually, like we have very limited pockets that are busting all over. Like especially new green energy stocks, charging stations, companies, and SPACs to a degree, because there's so much cheap money around. Of course, we do see that. And of course, it's easy to get that tainted view. But I just drove past the Denny's here in North Vancouver, and all they have is a patio. It was raining. There was nobody sitting there. And that's Canada. It's a bit different than the US, like in overall because of COVID. But like I have a hard time grasping that. Like we're not at 100% yet. Like especially the US is a service-based industry or like very service-focused. I don't see it yet. Like it's very limited pockets. Of course, real estate is bubbling. So if you want to say that like that's the overall economy is bursting, sure, if you want to make house prices accountable for that, we have the same thing here in Canada, but that's not representative of the overall economy, right? In my opinion. So there are different ways to look at it, and I don't see it just happening yet. And I remember before the pandemic, we were actually talking about companies not being able to hit their quarterly estimations, actually suffering. Like not suffering is a strong word, but not being able to deliver the returns for investors and delivering the results anymore. So we did see a bit of a decline, and now seeing this hype is interesting. Like I have a hard time when I hear that. And before you interrupt me, I was going to say, well, Canada's having its strongest economic quarter, or the third strongest economic quarter in history. Like, what do you make that? Like, what do you base that on? Like, that's not a stat. We pretty much came from zero in March last year. Like where we had to shut down everything. So of course we're going to have a great comeback. Anything above zero is great. Like even one is great because you're up 100% from zero. Okay. Like does that make sense? So I have a hard time with those numbers because you got to put it in perspective.
We're up 10% today, although we were down 99% yesterday. So.
Yeah, it is exactly what that is. And that's what the media is reporting. And like looking at it, of course we're doing better than we did probably in November. Okay, because things have changed, especially in the US. Again, I'm here in Canada, so I'm like a bit isolated from all that. But of course, it's doing better than November. Like, but we're still, and in my opinion, we're still not back at break even. once we were 10% above break even, we can start cheering and clapping and being happy about it.
Yeah, well, I think we got a little ways to go before we get there, but let us. A question I had: you mentioned some of the tech stocks were doing well that were going green. Would that not be an association? Usually, the going green stuff I hear requires silver. How would one factor that in?
It's a really interesting development, and I've recently just started broadening my horizon. Like I've been really gold, silver focused, but just really metals and miners focused. But we're seeing a bigger impact happening with the green energy revolution. So I'm starting to look at more like SPAC stocks actually that have started investing into our space, although they haven't really come our way yet, as meaning in the miners. But charging stations. What does that mean? Tesla talking about, even on their earnings call this week, I think it was on Monday or Tuesday, about solar panels and wall charging. What does that mean? Like, what does that mean for our industry? And we all need more silver. We need more copper for that as well. So it is interesting to follow those trends. And of course, you got to keep in mind, like GDP to debt ratio is insane. And one thing to increase the GDP, you got to value add to your products. And that's a big part of how I see, besides inflation, by the way, like adding to the GDP and changing maybe a bit of momentum on that GDP to debt ratio.
Yeah, and speaking of inflation, I know that there's a big concern in Washington. I actually stopped by there last week. A beautiful time. Because they were able to, I felt more safe from the low inflation pandemic there, being in the same town as the Fed. I forgot to stop at the Federal Reserve. Where is my mind sometimes? But despite the low inflation pandemic around the Fed's office, it's interesting looking at some of these commodity charts. We'll stick on the 3-year. There's wheat, nice, looks like Bitcoin spiking up. There's corn. Soybeans are getting a little pricier. Soybean meal has come back in recent months, so that's, to be fair, yet soybean oil. Kai, you can pick your favorite commodity as we go along here. Looks like rough rice is staying in check, although hard wheat skyrocketing a little. I'll see if we get to, wow, look at spring wheat. Ooh, that's not getting cheaper, buddy.
I think I'm in the wrong sector, sir.
There is, and I keep hearing about lumber. I'm not sure what the symbol for lumber is, but, and I hear mining companies often use inputs. So how does all of this, and then you have companies going green, it just seems like a lot of building factors to me.
It all comes together. It's interesting. Like where do these like price runs come from? Like what are they based on? Right? Like I've been hearing, for example, lumber, like even in Canada, we've had a lot of forest fires in 2018 and 2019, taking a lot of the supply away. Right. So those things, and I'm not like, it's interesting to see an overall agriculture or commodity run in the on the ag side. So
look at those hogs, Kai. Look at that.
There you go. If you want to invest anti-cyclical, there you go. Feeder cattle right there. Yeah. Lean hogs, it's crazy. No, and we haven't even seen that come through all the way to pricing yet, but we do see Coca-Cola and other companies increase pricing, and that's the inflation we're wanting to, like, we don't want to see it, but we will see it, right? And that is happening. There's a lot of sable rattling as well, like the US and China. Like, what is happening there? What does that mean? Like, are we going to be able to sell our hogs to China? Like the US be able to, vice versa? Soy. It's interesting. Like what's happening with COVID in Brazil? Like, what's the demand? Sorry, not the supply. Like, and like, I'm not an agriculture expert, right? A lot of speculation on my part. But that, with COVID going rampant in Brazil, how is that affecting soy? I think that's a lot of that is reflected in those prices. And of course, it's overall speculation. Like I think a lot of speculation driven. I'm not sure everything is fundamentally sound there. So we'll have to see. We'll have to play. I'm not an expert on that, so I'm a bit out of my depth here, to be honest.
Well, Kai, good news. I did find the lumber chart, so we'll pull that up. And I mean, I know there's certain areas which you have expertise in not. Do you have any thoughts if this looks, this chart, would you say this is deflationary? Is this not enough inflation yet? I mean, That's lumber. It looks like it's
well, that's inflation 1.0 right there, right? That's what you usually learn right in school. So we see inflation with lumber because housing prices, like all of a sudden your house costs $30,000 more because of all that lumber you need, right?
So if it's tripled since November, is that above 2% annual?
That's a trick question, Chris. I think it is, but you know what hasn't gone up? The cost to renew your driver's license. Okay, that remained flat. So we're actually deflationary in terms of driver's license renewal fees.
Although, while driver's license renewal fees might be slightly under the 2% Fed mandate, this is interesting that if you see back in March 30th of 2020, so I don't know, 13 months ago, we got as low as 251, and at the high of 1468, that's a six-bagger, which seemingly would also be above the 2% inflation mandate, right?
Barely. But of course, it's a result of cheap money, lumber in particular. Result of cheap money. People can get a loan or a mortgage for 2%, 3%, 4%. Like,
wow,
really cheap money with zero money down most of the time.
All Imagine right. If you had gotten cheap money and purchased copper last year and got a nice double on that one.
That looks fantastic. That chart, 450. I haven't even looked at it today, but is it really 451? That's insane. Like, it's fantastic. So, of course, you can participate through the mining stocks, but copper is a economic indicator. Dr. Copper tells you where the economy is headed. So we're definitely trending up, and Dr. Copper is telling you the economy is on a track to recovery and doing really, really well. So that's interesting to see, of course, right?
Well, yeah, I mean, you could say certainly it is heating up. Maybe that's what Zandy and the other hot money economists are talking at. Although here's where I always just get a little confused, with some of my old-fashioned ideas. But if it's all based on printed money, doesn't that kind of skew the equation a little bit? It's like, if I show up bragging about my 6 Ferraris, but I only got it for another 3 hours before I get a margin call on my line of credit, is that kind of what the Fed is leaving out of their press release of the brilliant? I mean, would the economy be as hot? Would copper be spiking if 40% of the dollars in existence hadn't been printed in the last year?
It probably wouldn't be, but also there are other factors going, like the infrastructure plan, the money yet to be printed, right, is going into that as well. So of course it's a bit forward looking. What is a bit sad to see, like when I grew up as a kid, the goal was like $1 million or €1 million. That was your goal. Like that was that benchmark that you always wanted to reach. Like, what is it now? Is it 5 million? Is it 10 million? What's the benchmark you need to reach that same level? I actually don't know. It's a bit demotivating, to be honest. Right, to see that, because you work hard and you try to get to that childhood like dream level, and the goalposts are being moved even further and further away. It's like, no, you can't. Like, you're not there yet, and that's very frustrating to see. I'm sure some of your viewers can relate to that.
Yeah, I think a lot of people can relate to that, and also, fortunately, aren't complete morons, because you can rig the gold and silver price if you want, but I think people start to notice, I don't know, I've been reading a couple books about silver from back in the 80s, and it always just makes me chuckle when they talk about the price of the car or what they were paying for lunch. And I think that's why they do it. That's why this trick has been used throughout history, because day to day, you don't notice it. And when it's constantly making life more expensive and more difficult, so it's difficult for people to take a step back and say, wait a second, something's off. And then even if you do find something's off, what actually does one do about it? Which, again, is why I appreciate there are people like you who study this. And what would you say in this environment? How do people address that?
It is almost, you got to hedge. You got to have something that goes up when your money gets devalued, or that it at least remains its value. That's all you can do, right? Hoarding cash is not the solution, because it will be worth less, of course. Physical silver and gold is pretty much the only option you can hedge there, right? Of course, you can play along. Of course, you can throw your money at the S&P 500, which has been hitting record highs after record highs the last 2 weeks, which is ridiculous to see, to be honest. But it works. Like the index has been going up like crazy. right? So it's easy to make 20% a year on the S&P 500 these days. So you have to play their game to a degree. Of course, you got to be on counter-cyclical, and I think 10% of your portfolio is not even enough to have in gold and silver right now, because like that black swan event that actually topples everything over could happen any day. I have no idea what it'd be. Like one time I heard maybe it's Deutsche Bank falling apart. Like I don't see it happening, to be honest, but like stuff like that is if a bank fails, or we do like I mentioned earlier, like we see 1-2% mortgage rates, but with zero down. Like, what happens if we see those defaulting again? Just watch the movie. I think it was The Big Short. Just watch that again. It sounds like it's happening right now again. Like if you watch that, it feels like it was filmed yesterday, right? So and that's the stuff. Like you can't. You can play along, try to make that money, but also take money off the table and put in something real. Buy a house with cash and make sure you don't have any payments on it. That's phenomenal if you can do that, because nobody will take that away from you. Buy a nice piece of land and some water rights somewhere. Buy some farmland that you can rent out or like lease out. That's fantastic. I think that's how I would play that, and that's how I personally play it a bit as well to my capabilities.
Yeah, well, that makes a lot of sense. And Kai, you talked about there's a lot of different ways a situation like this can unfold. I'm curious if you have any comment on what I found in this one of the CFTC, who talked about apparently something did happen, and let's hear what he said.
And in many respects, the resiliency and the market structure of the futures market really were able to tamp down what could have been a much worse situation in the silver market.
So Kai, it's interesting. Now, I think I'm the only one so far that has actually submitted evidence, or not, I don't want to say submitted evidence. I don't know anyone at the CFTC who has any idea of how to explain how the price of silver fell 10% on February 2nd, which at least by the ETF count set historical records by a mile. And then the dealers, I mean, they couldn't even call everyone back. They had so many calls. So arguably the greatest single day of silver demand in history. I explained it, and yet here he's talking about something that almost got out of control. This was posted initially March 18th, and he's saying something had to be tamped down. I don't know, is that the kind of thing that you were talking about when there's black swans, or that things are told to be one way, but then when you find the things that they don't put on the front of CNBC that most people never look for? I mean, when I first saw his commentary, there was 78 views on the thing. So would that be an example of what you were getting at?
Yes, but you need more traction. So it needs to be something bigger. It needs to be, and I hate to say, but it needs to be World Trade Center 2.0, something like that. Like something you don't expect happening that can topple everything, right? And I hate making that reference because it was a disaster, but like an event like that. Like these videos are great, but it's a select few, like we are seeing it because we are in the industry. Like it rouses us and makes us like angry and furious. But then I had a conversation with Greg Hemke the other day. Like, what can we do? Like, all we can do is provide visibility and reach out to people that are willing to listen, to advocate, and show them and teach them what is sort of, or not even teach, but show them what is happening behind the scenes. To a degree, I'm not protecting the CFTC, but I don't think they know what's happening, to be honest. Like they are there, they're the regulators. Like BaFin in Germany, for example, which is our regulatory body, completely missed the Wirecard scandal. Like it turned out they owned shares in the company and investors lost billions. And there were a lot of warning signs. Even journalists, like of reputable financial newspapers like Financial Times, said, okay, this is garbage. This doesn't make sense. It doesn't add up, right? But they only react when it's too late, because there are various motivations playing into that. Like if you sound the alarm too early, you lose your job. If you sound it too late, you lose your job. So what do? Nothing, right? So, and there are so many factors and interests playing into this. Like I'm really like struggling to see what we can do. And I love your efforts, by the way. I really follow closely. But what is it do we need to do? Like who's that one person that can start like really kick that off? Like what is going to get the ball rolling? And what do we expect as an end result? And I asked that Greg Hemke on I think it was Monday afternoon as well. Like, Greg, what do you expect to happen actually? Now you're sounding the alarm, But let's assume this unravels, okay? It comes out this is a big scam and it's based on nothing, right? And it's manipulated all the way through. What is the end result of that? Like, I'm not protecting. I'm just trying to figure out, like, that's where my pragmatic brain goes.
Call on me.
Okay, right? Like, but where's this headed? If we call this on, like, we're not going to go back to our silver-backed currency at this point, like, or a gold-backed currency. So I'm just curious, like where is this headed? Like, and that's an idea, like, for me looking up at the stars and not knowing what's out there. Right? It's like that's where my maybe imagination sort of ends as well. Like, what do you think? Like, maybe play the ball back to you there.
Sure, Silver Chris would love to take a stab at this one. I actually did a roundtable with Craig this morning, and we talked about some of these things. So what do I expect happen? And I'll also say why I think it's happening. My best guess is that we do eventually get some sort of cash settle, because when you think about it, in terms of what I think is most likely to happen, I wouldn't bet on what I think is fair or right or what should happen, but the people are good at cheating and, controlling these things. What are they most likely to do? And I thought it's interesting how a couple folks have mentioned the cash settle on the COMEX, which the contracts are legally worded. So the COMEX can say, all right, we this or that, here's $26 for your silver. But in the open market, it soars. I don't know how something like that doesn't eventually happen. Again, we got this report from the LBMA. They said after the first 3 days of silver squeeze, they were about a week away from running out of all their silver. And they said as long as that never happens again, they'll have plenty. Okay, but now there's already people talking about doing it again this weekend. And now you have Wall Street Silver, which is 60,000 plus people. That group didn't exist the first time. So now you've had like 3 months of learning, and also the LBMA and the bankers just said, hey, we were crapping our pants on that one because we were running out of silver. What they were doing was working. So, hey, how long does it take? We'll see, but that would be, to me, the most likely probability of some sort of cash settle, because on top of it, I get it that they're not going to give up the gold and silver until they have to or give up the price control. But there's some point in which you just run out. That's what happened. This is the exact same thing that happened in London Gold Pool. And people are saying, well, if they do a reset, they'll try and control it after. Of course they will. You had London Gold Pool collapse. A couple of years later, you had the CFTC and the COMEX. So when the COMEX collapses, I don't know, maybe a couple of years they'll be like, hey, let's do the COMEX part 2. Like it's like the second part of a movie. But the reason why I think it's even likely in some sense, because if they can cash settle and then just let's say they reset, the higher the number you reset it to, the more debt you can wipe out. Even if the U.S. government only has 10 ounces of gold, fine, make the gold price $10 billion, wipe out the debt. You don't have banks going insolvent because they're getting the COMEX long holders are going to get screwed. But I think that almost some form of that has to happen, or I don't know, maybe it'll just get overrun and they'll let the contracts keep trading and make the shorts eat it. That seems harder to see, but I guess the last thing, and then I'll let you take it back over, but I've thought of what is the difference now versus any other point in time. And ironically, I don't think it's that, we needed more numerical calculations or specific evidence, but now that there are smart asses like me that make videos commenting on the silly things some of these guys say. And then you have people in these Wall Street Reddit groups or otherwise, but that you finally have the young people involved.
Yeah, that's very good points, man. Like you finally get the masses, and that's happening. That's it's interesting to see. And Keith Neumeyer said that as well. Like he thinks change is coming now from retail, not the commercials. Right, he thought commercials were in the driver's seat, but his opinion is changing, that retail is actually pushing commercials out of the driver's seat and into the back seat, and that's interesting. Exactly the point you're making, right? So I really love following this. This makes it really interesting. Like the silver squeeze, I did an interview with your friend Rob Keynes actually on that Thursday before the silver squeeze, and I was saying, Rob, like, what are we doing here? Are we just masochists here? Like, why are we in gold and silver? Nothing's happening right now. We're just trending down. It's just boring as fuck. Right. So And then that afternoon, I was eating crow because the silver squeeze started to happen and started to really gain traction, and the whole excitement came back to the sector, right? It's really interesting to see, and really curious to see where this goes, because my imagination probably doesn't reach far enough. Is it cash, as you said, cash settlement? What is that going to do? Because there's so much involved, and you talked a lot physical. Like, how is that paper site going to unravel? It's the SLV, all that paper silver that probably doesn't even exist anywhere. It's just paper. It's physical. Like, it doesn't exist. It's just paper. But what does that do? Like, and you've heard the Archegos, was it Archegos? I'm probably butchering the name. The Archegos Capital thing, like where the Credit Suisse was on the hook for $10 billion. Like, we don't even know who's behind all that paper silver and what that is going to do once that starts to unravel, right? So there are so many interests at play, where my imagination just ends. Seriously, like that, almost like, I hate using that word because everybody can fail, but too big to fail. Like, there will be some unravelment, but then there will be smaller banks like a Lehman or so collapsing, right? When that happens, but it's like my imagination doesn't reach far enough to this point. Like, are we going to see $500 silver? Because when that happens, I don't know. And the other question, how healthy is that on the other end for the producing cycle on the supply side? So, like, a lot of I love these conversations, discussions, right? So,
yeah, I think it's a great point, and I don't know, when I first left Wall Street, the first time I left the US, it was because of fear, thinking, geez, when this goes down, are we shooting each other in the streets, or that guy's killing someone for dinner? Although the more, and especially this is accelerated in the past few months, the more I see how almost every part of all of this monstrosity is some fear boogeyman that's stuck out there. I mean, the Archegos, or however you say it, 10 billion. The numbers are still growing. People are forgetting about the Greensill Capital Fund. That was just a couple weeks before it. So here's tens of billions. I mean, the world continued on. Why is it that if silver goes to 50 or $100, I mean, for decades we've had that indoctrination. Oh, the world's going to end. You don't want to live in that world. I mean, if everything else is printed over, is it at least, I'm not saying this is right, but just is it at least conceivable that whole school of thought is another whopper engineered by the banks, indoctrinated, so that you feel like you're the terrorist buying gold and silver? And Kai, you even mentioned it when you killed the interest. Why has the price of silver, we hear these people saying it's going to have to go up, but we've had last decade, it's been $20 for the better part of it. But that depended on killing the investment demand. And now that the investment demand is picked up, the whole thing's unraveling again. And it's not an accident. The LBMA told you. And they told you how much money they have left. They said they had 360 million ounces left. And they said the ETFs had just put in 120 million in 3 days. They didn't even count the coins and bars. I mean, if we even knew what that number was, it could have been a day away. And it still could be a day away. And they don't even deny that. They flat out tell you. And then they have on the closing of the report says, they're like, well, could this occur? Well, if it does, we're completely screwed. But we don't think it'll happen because it took COVID to create these circumstances. And I'm sitting there thinking, if you think that the reason silver purchases surged at the beginning of February was because of COVID, that just shows they have no idea about what customers are actually doing and why people are actually buying it.
No, absolutely. I fully agree. And seeing that, and you mentioned the LBMA report, they don't even know. They don't know. And in the end, maybe a few select know, but it all comes down to money and power, right? And
whatever it is that the CFTC guy is talking about, he said he was grateful that something tamped down what was going to be a much worse situation. What was the worst situation? Was it that the scheme was unraveling? That's what it seems like to me. Kai, what do you think?
No, it's like I'm with you on that. Like, the facts are facts, right? If you're out of silver, what's going to happen? Price is going to go up, right? And then you got to figure out, like, okay, you got all the silver puts and the options and everything, and that's going to set off a whole fire, like a whole fireworks of effects, right? So that's what. But the CFTC, like, they're just, for lack of a better term, just Muppets. They're watching what's going on, but they're not dictating what's going on. Right? They're just following as closely as we are. And maybe they have a bit more insight because they can reach Jeff Curry directly, potentially, the head of the CFTC. That's the difference. They might have a direct line.
That's pretty baller, I'll admit. That's pretty
right?
cool.
It's like, yeah, it has its perks, right? But my point is, like,
I didn't get a call back from Jeff. I did leave him a message.
Okay, right, but like that might be the difference from that between them and us. Like they might be making some policies, they can have some input, but they base it on reaction, like on what they're being fed, whatever it is, right? And they can audit it, but like they are basing their findings on what they're being fed. It's not like they're making the facts. It's not like they're the ones physically sending photos of, okay, we're counting these silver bars right now. It is whatever the LBMA says, whatever Goldman Sachs says, and they have to gobble it up because they can't verify it probably.
Yeah,
right?
I mean,
so that's why the CFTC, like, they're a toothless tiger. Like, they can help with policies and all that. Like, and even if they were to bring something forward, like, let's spin this further. And I probably watched way too many Hollywood movies, right? But let's spin this further, and the CFTC goes to court. What is going to happen? Like, the banks are just going to squash it with $1 zillion worth of lawyer hours. Right? They were going to find some reason that something wasn't done. Like, and that's more my Hollywood mind talking, but that's what I see happening. Right?
Well, you know what I see happening in response?
Tell me.
I'm actually, I don't think I mentioned this on the show. I've made a couple movies for the channel this year. I have started mapping out Silver Chris versus the CFTC. And I don't know. I think this young whippersnapper, he might have something to say. He might have a trick up his sleeve. We'll see. But it'll be fun to watch. And it's, I mean, partly, I don't know. I mean, the reason I feel so confident, maybe it sounds like I'm being arrogant, but I mean, the reason I say these things in a way that I do, I'm just comparing their own data. I'm just putting the clips. Hey, this guy said this. Here's his buddy saying the exact opposite, you know? And so that's why, I mean, that's what I love about it. No one has to take my opinion. It's not up to me. It's not up to you, Kai. It's like, I don't know. They said they were running out of silver. What am I? It's not my fault.
No, it's true.
You didn't do
surprised. I'm actually surprised 550 people are watching this right now and wanting to listen to what we have to say. Right? Like, we can. It's interesting. Like, there's so much. There's. I could go, like, it comes down to appointments of committee members and all. It's like that all plays into it as well. Like, when the Fed chair steps down and all of a sudden he becomes a consultant for Goldman Sachs, like, stuff like that, like legal or not legal, that's still to be debated, right? That hasn't been figured out yet. But things like that just make it almost impossible to properly police this. And it's and I don't want to go down further that rabbit hole, but it's very interesting conversations, and you end up sounding like a conspiracy theorist at the end, although it's all based on facts and your opinion. Like, it's interesting because you get pushed in that corner, and you start.
I get what you're saying. Right. Although, to me, one of the things that I don't know, I guess I had to learn. I used to be very sensitive, and then I don't know if you have a lot of people watch anything, there's gonna be some guy who runs his mouth. So I found, like, I guess when I got to the point, like, now, I don't know. I mean, I'm sure I've made mistakes somewhere here or there. I mean, if I didn't become aware of it, I say it. But I know I'm genuinely doing the best. I could be a complete moron and maybe I'm blind to it, but I know I'm doing the best, and I'm not trying to lie, and I lay the stuff out there. So if someone thinks it's conspiracy theory, great. Hey, I'm grateful that I've gotten to the point where there's enough people who want to hear what I have to say, and I share it, and I think I have a pretty good track record, to be completely honest. And I think that's part of it, is that whenever we get to the point, maybe that's what confidence is, when you just, hey, this is what I do. If it's helpful, I'm happy to share. You want to talk about it. If you think I'm an idiot and you want to go do something else, great. Knock yourself out. And when you said policing the markets, I think that's what I think we're doing, and you're doing with your show, where it doesn't have to be police with a badge and, you know, coercing someone like government, but just sharing the truth. That's why I think the 500 people are watching live, or that they go to your site and watch live, because they hear this crap from Goldman Sachs. Some people remember Goldman Sachs selling shitty deals or getting the thing clobbered over and over again. I think that's why they're hungry for the stuff that you share. And Kai, perhaps in wrapping up, you could let them know where to find you, and any other final thoughts, or if anywhere in this interview you figured out anything the Fed could possibly do that wouldn't be a net positive for silver, And so to take it from there.
It's tough to think of something right now that the Fed cannot do, or it can and cannot do. But then again, I'm always surprised because I learn new terms pretty much every week in terms of yield curve control, reflationary, things like that, like words that have never been used before in the English language all of a sudden pop up, or at least in this context, right? So it's interesting. I'm bullish long term. I've always been. I understand the true value of where this is headed. It's interesting, like where we're heading, and I really like seeing some momentum behind it, like that Silver Squeeze movement, Silver Squeeze 2.0. It's interesting, and that Reddit group is interesting to watch. It's like online has given the whole thing a bit of a voice, and it's great to be able to channel and direct that, right, and into the right channels. And if it's reaching out to the CFTC at some point, they will listen, because it will, you will reach that threshold. That's what I mean. Like, what's the last drop in the bucket that'll make it flow over, right? That's what I'm looking for. That's what I've been like searching for as well. Like, what will be that last domino that will fall and start toppling over? So that's what I'm looking for. I like listening to both sides, to be honest. Right. I know you have a bit of a beef going on with Jeff Christian, and I'm still working on that, like trying to figure out like both sides. I find it really, really interesting. I try to keep an open mind because there's always two sides to it. But I'm definitely long-term bullish, whether it means draining the physical supply, whether it's getting rid of the paper silver. Like long-term, I think we're trending up. So I'm positive. Like, and I hope people follow us as well at Zor Financial on either Twitter or Zor Financial is the YouTube channel as well. YouTube.com/Zor Financial. And appreciate you having me on the program, Chris. Yeah, if you scroll down, you can actually see some of the videos and things we've done, right? So with some of our guests, but the YouTube channel, Twitter channel is like where I'm most active personally as well. And this is more the corporate website behind it, of course. And we do host conferences. May 24th, we're hosting Deutsche Goldmesse, German Gold Show. We are focusing a bit more on future metals in our next SF Online Session 9. But that can also include silver and copper. It's not just the lithium. I don't want to talk just lithium. For me, that's everything in that regard, because there is a bit of a paradigm change happening, Industrial Revolution 4.0 or wherever we're at right now. It could be an interesting trend, which benefits precious metals just as well as base metals.
And are the Germans buying silver yet, Kai?
Yeah, if you actually go in the Reddit group on Wall Street Silver, they are. They're happily stacking. It's in our DNA to protect ourselves from inflation, as because of the Weimar Republic and our hyperinflation scenario back in 29. So it's in our DNA. We're avid gold bugs, and we got some great speakers at the event. So it should be quite a bit of interest.
You got Keith Newmeyer, Ross Beatty, some silver action in there, which is very lovely. I like that.
So yeah, it's not just like we used German Gold Show because we started organizing the event last August when gold was rallying and the sentiment was extremely bullish. So, but it includes everything. So we got some silver companies. I think Defiance you mentioned.
Oh, is this saying we got Defiance there?
So they will be presenting. But we also have like copper, silver. Like Van Gold Mining is a silver gold company. Just looking at Apris Silver is going to be an interesting one. That stock has been rallying. We got Josh Crump, who was actually a former analyst at Goldman Sachs, presenting.
Who?
Josh Crump. He's the guy in the middle, founder of Gold Money and Apex Technologies. Wow. He was an analyst at Goldman Sachs before.
Do you think he knows Jeff Curry?
I think he worked right under him. He knows him.
What? All right. I want to buy a ticket.
It's free to attend. Free to attend. Just sign up and show up. So.
Wow. Well, it's actually interesting. Again, not legal licensed financial advice. Although I'll bet if you just bought this portfolio and left it for 10 years, it would work out extremely well. Just my opinion. I'm not telling anybody else what to do. But Kai, that looks like a hot little party you got put together there. So I'll look forward to checking that one out. Some good companies in there. Oh, you got Chris Taylor showing up too. I know people like hearing from him, and quite a successful. There's Endeavor. So Kai, again, that will be on May 25th. You can find Kai at sorfinancial.com. And is it the Twitter is at Sor Financial? Is that right?
Exactly. Yeah, at Sor Financial. Like you'll see my face there. I'm wearing sunglasses. For some reason, I can't find any better photos of myself without sunglasses. So you got to deal with that. But other than that, yeah.
Maybe you can capture a screenshot from today. I think you look sharp today. So
appreciate that, Chris. No, I'm blushing. I hope that.
Yeah, no, you're gonna turn some heads walking down the street. So I thank you for joining me. I'm gonna go pick up my beautiful mother is coming to visit me today. So I'm gonna go head to the airport And but Kai, I appreciate you checking in. And if anybody does figure out anything the Fed could conceivably do that wouldn't be net positive for silver, leave a comment below. And I don't know, maybe there's a scenario out there. But Kai, we'll check back in on it soon, buddy.
Chris, was awesome chatting with you. Thanks for having me on, bud.
And we.
Hey everyone, this is Rob Keens from goldsilverpros.com. It is Wednesday, April 28, 2021. I have an extremely special program for you today because we're going to talk silver, and more silver. A lot of you guys have been wanting me to do this lately, and so we're going to dedicate a program entirely to it. Now, I'm going to talk about some things that I talked about in the Cowboys Metal live stream that we did Sunday. We have every Sunday, 1 p.m. Central Standard Time, when I was broadcasting from DC, and we covered the May Day Massacre, which is basically, we're coming up on the 10-year anniversary of that. And that is the 10-year anniversary of the silver price falling from touching on its all-time high, the $49 to $50 range. We're going to talk about that. But I've got some other very special information for you in this presentation. I don't think that you're going to want to miss it because I'm going to cover a lot of ground here. I'm going to give you some of the view on silver from officialdom, and then we're going to look at some legalities and things like that that I think is very, very important. I think that there is some potential misinformation there floating around, and I think some of it just stems from different viewpoints on the market and different viewpoints on why the market exists. And that's getting to that fundamental perspective is really what I want to do. But we're going to start looking at the silver price. And as promised, several people have emailed me and asked about this on comments on other shows. We're going to look at open interest and the May contract as well. Note that we covered this. I covered silver and gold a lot last night on the Miles Franklin channel. You can see that video if you go to Miles Franklin on YouTube. Look at their latest video. That one's trending up. I think it had 11,000 views last time I looked at it. We may get to 15,000 a day, which is really, really good. And I also, on Friday, will be on Dunnigan Kaiser Show on Liberty and Finance on an all-star silver panel. Please stay tuned for that one. We believe that's going to be released Friday, just in time for May 1st, which would be the following Saturday. And then stay tuned to this channel because on Saturday, we're going to do a broadcast during May Day, and we're going to talk news and all things silver on the big day. But let's jump right into the charting real quick because that's what you guys have been asking for. So we're looking here at a 100-year historical chart of macro trends. One of the reasons I wanted to start with a long-term chart is because depending on how you look at silver is your perception of where silver could go from a price perspective. And I think also the way that you look at a chart can influence how you see it. So I'm going to make that point here by just looking at a regular non-inflation adjusted chart of silver. We can see that as it was, money in the financial system per the U.S. Constitution, we had silver in our money up until the point at which it was released from that obligation. It started rising, and then we reached a high here in about January of 1980. We can get to focus on that, 35.75. That's non-inflation adjusted. So then if you look at the next rise in silver during 2011 when it hit, let's get that price there, 48.60. I think it really touched on almost 50, a little bit above that on some other information I looked at. We'll just call it 49. It reached what looks like a much bigger high, but that's not inflation adjusted. So if you take CPI index and you apply that to this chart, it changes quite a bit. So, and that matters because gold and silver are really the measure of inflation, especially gold, but silver to some extent as well. That's why they were money, because when you have them in a system which is non-fiat, they retain more and more and more value over time. They slowly appreciate in value. When you have a fiat system, the fiat dollars are printed more. Those prices for those metals should go up, and we should expect a pretty high price rise. So if we're looking at this, you're saying, well, it's peaked a couple of times, but somewhere in this range is probably the real price of silver if we looked at CPI. Well, let's click the inflation adjusted chart and see what happens when we add in that CPI data. Now, before I do that, just to remind you, I don't believe CPI data is actually correct for reasons that I state in my book. If you go to my website and subscribe, you can get a copy of that book. Chapter 2 has 50 pages where I use government data to examine government statistics and challenge inflation and many other things. I'll just suffice it to say I don't believe the CPI numbers for very good reasons, but we're going to use them here because it's on the chart. So if we hit that adjusted for inflation, notice everything changes. I'm going to take that off. And it looks like the all-time high was actually in 2011, and not in 1980. But if you inflation adjust it, then you see a much different picture. Inflation adjusted just using the CPI, not what I think is real price inflation, real world, but the modified government inflation, silver touched up over $120 in today's money. That means the value of money significantly has declined against the price of silver. Silver came down and was trading below $20 for a longest time, even though money supply was being printed. And then we had a spike in money supply last year due to the pandemic. I've showed the M1, the M0, the M2 charts on my videos many times. We just showed it earlier when we were talking to Sailfish and we were talking about oncoming inflation earlier this week and gold royalty companies. We talked about inflation. I showed the M1 chart and I showed the hockey stick move in 2020, where we had printed so much money, the M1 measure of that liquidity of money. And then it literally in 2020 last year went vertical as the government printed a whole lot more. And if you average that in, silver's price as a result should be much higher than it is. But as we see inflation adjusted, it's nowhere near where it was in 1980. Inflation adjusted dollar, today's dollars in 2011 was 57.25. So the nominal amount was 49 bucks, but we've inflated away an extra $8 per ounce of silver. This is how you read that between 2011 and now, a value. If when we've inflated away, if you look at that $125 price, I believe it is what it was, 121.73, we've inflated away a lot more than that. This is where silver should be at least in 1980 terms, in terms of inflation. And we're not talking about scarcity or the additional uses of silver, the additional demand, industrial demand and investment demand that's occurred. So it should be really, the price of silver should be a lot higher. So depending on the way you look at the chart is where you can sort of set your price targets if you believe in a true free market. And we're going to get into that true free market here in the program. Now, I could spend a lot of time talking about this. I'm going to move through this stuff fairly quick because we're going to come back, like I said, on Saturday, talk about this more during May Day. And I'm going to give you some more data. We're going to talk about some news stories and things. So we're going to move fairly quickly. But I've got the silver chart up here. I've got the shorter term chart. It is about the 3-year chart, give or take. And I really want to focus on what's been happening since March of last year when silver started its move. It was trading about 11 bucks, 12 bucks, and it popped up to about 29, almost 50. You can see here, just above 29. It was going to get to that $30 line. You see this red line right here at the top? That's that $30 key key resistance line in the silver market because it has not wanted to bump up against that for a long time. If we take the inflation adjusted away and just look at nominal prices, the last time it was up at $30 was really in the 1980s. And then it hit it again in about 2010, 2011 during the run up. So that $30 is rare in silver and it is a key resistance line. So it's bumped up against it a couple of times. You can see here on the chart, bumped up against it August of last year, bumped up against it January, right after the presidential elections. There was a nice low bump here that I've covered on my channel a lot, this uptrend you can see outlined in these blue lines. And then it came down. Here's a little bull flag pattern. And then it popped back through the bull flag pattern and back through the 50-day moving average, which is this blue squiggly line right here, 50-day moving average. But the bigger trend is this big flag pattern. If you see since last August, it's bumped up against this key $29.50, $30 mark. But on the bottom, it's been rising. It's been this positive momentum. And I've got 2 of these here. If you look back since March, we have this really wide open flag. But even if we go forward a few months to July, we still have a really sharp flag of where silver is trading. That's a consolidation pattern, meaning the market is battling in this range. At some point, it's going to break out. That is a positive bullish signal. Now, just because we see this on technical charts doesn't mean it's going to happen in the future. It's not predicting the future. But as I was telling one of my subscribers who wrote me today about technical charting, it can, when you combine it with fundamental analysis, it can give you clues as to where the market wants to go. Because we're looking at a collection of millions of decisions around that silver in the futures market to determine that price level. And that can give you clues where it goes in the future when you combine that with fundamental analysis. And we'll talk more about that later on. I've talked about that in the past. In any case, there is a bullish signal here on silver. And remember, on the long-term chart, inflation adjusted, we've got a long way to run. And you know, there are a lot of things we could talk about here, but just using CPI, which is like the lowest level of any inflation anybody could agree on, and most people who are rational agree that CPI is understated, and know it is when you look at the government statistics and how they calculate them since 1980. We've got a long way to run, but it looks like in the short term, technically, it looks like we're getting this positive flag pattern that looks like it's going to pop silver up. So that is sort of the technical analysis and the price analysis. We're going to get into the futures. That's what people want me to do. As of right now, it's early afternoon here. We're trading about 26.10 or so on the COMEX chart. It's down about, 1%, about 31 cents. Not a huge move on the day. Overall open interest is up leading into May, the contract month of May. Right now, overall 115,000 contracts, futures contracts, although they're not actually in May. A lot of that is rolled off. You see today, 17,000 contracts, actually as of yesterday. That's actually, yesterday's data, Tuesday the 27th. We saw a lot of contracts roll off. I think the day before is like 11,000. Let me go back and do Monday's data. 14,000. So in 2 days, you've seen negative 31,000 contracts come off of this May contract and move into July, June, some of these other contracts. And this is natural. The contracts roll because it's a futures market. And what people are doing is hedging their various positions in the market on a forward basis in order to address their exposure to silver. Because remember, this is a derivative market. It's a derivative market, and therefore it's not the physical market. So people will roll their future positions overall, and that does affect the overall price. And that's why we say this is a paper price driven market, not a physical. We're going to look at physical here in just a moment, and we'll get into what the physical is actually telling us. So over here, open interest is falling. It's building up in the July contract. There's still enough open interest to skip back to the Tuesday data. I went back to Friday. There's still enough open interest to have a sizable amount of deliveries in May, but I don't think it's going to be what we thought it was going to be originally before. However, just because there's not a lot of open interest doesn't mean you can't have some healthy deliveries. And I think the deliveries are coming on the retail side, not the industrial side anyway. And that's what we're going to spend some time talking about as we move forward in this presentation. That, the incremental demand and the whale in this market is actually retail demand, not industrial. David Morgan has been on my channel saying that many times, as silver guru. I agree with him. It's the incremental investment demand which really moves the price of silver over time. And the fact that the whale of all these people getting interested in silver in the retail trade could be much bigger potentially than what we see in the industrial trade. And I'm going to prove that by showing you some data about what happened earlier this year. We'll get into that. Anyway, that is where we are in the open interest and where we are potentially with the deliveries. 14 deliveries there on Tuesday's data. On Monday's data, we had 18 deliveries. We had a little bit EFPs, 95 there on Monday, Tuesday. We had 192. So a lot of arbitrage between the COMEX and London through that exchange for physical mechanism, EFP right here. If you guys need to know more about EFP, look at my Cowboy Metals live stream from a week and a half ago, and I go over what EFP means that way. That's the reason I'm not going to explain it in detail here. Now I want to go over deliveries. So this is the deliveries for silver futures printed as of 4/27 from the CME's website on the silver contract. So we've had, a fair amount up to 29.87 total from the first notice date of March 31st to the last date that they have the data here, 4/27/2021. I just loaded this sheet here about 20 minutes ago. So this is the latest and greatest. Now the deliveries aren't going to just blow you away, but I suspect in May they'll be higher because you have higher overall open interest here. I don't know if we're going to get 80 million ounces delivered in May, but we should get a fair amount delivered on the COMEX. But we're going to look at some other things here in a moment of where the deliveries could come from. Now I wanted to take you to gold charts or us, because really in the title of this video, we're talking about silver coming off of COMEX. And this is big. What I've explained many, many videos before is that since 2000, you saw this amazing buildup of silver on the COMEX. And they created basically the eligible stocks, meaning all of this prior to that could have been considered for delivery, or it could have been storage, but it was all lumped into the same thing. Then they physically separated on their accounting the eligible and the registered stocks, meaning eligible is just vault storage, no warrants or receipts or anything attached to that metal where it could go for delivery for futures contract. So they created the separate basic categories of registered and eligible. Registered is what could go to a futures trade. Eligible is what's just sitting there in storage. And for the longest time, silver was building. You see the same thing in gold. So there are record amounts of silver and gold on the COMEX, and people said healthy, stocks, not a problem. Well, the CME group came out April 9th last year, a year ago, and basically stated that they think there's a 50% haircut here in what eligible could be used as deliveries. And the reason they said that, and they said, well, it could actually change. We don't actually know what it is, because all this light green here, this is just storage. You can't force that on the market. It's privately owned. So really, when we want to know how much silver could go against a contract, we're looking at this green. And notice there was at times when this got really thin. When we look at 2016, there was a little bit of spike in silver price. This got really thin, and then it boosted up quite a bit. A lot of the reason why silver stocks have come into COMEX is because of that EFP trade. Because if there's a big difference between the price of the future and then the spot contract in London, it can pull silver from London and even from the refineries in Switzerland onto the COMEX. And that's why a lot of the buildup came. Of course, we also saw JP Morgan in July of last year, and I documented this last year in my videos, took 30 million ounces from their, the light green eligible category and put it in registered. So those two combined things, the EFP action price arbitrage, which actually pulled silver over to the US from London and from Switzerland refineries, and JP Morgan saying, well, we've got 30 million ounces sitting on the COMEX, but it's in private storage. We're going to put it registered eligible. That provided the liquidity we now have. Now, the astounding thing is you see this huge drop off. So this is the first big drop off we've had in silver since that 2016 time period where you had a nice price, and since that 2006 to 2010 time period where you had the lull in the precious metals market before the financial crisis. This is the biggest reduction of overall stocks in the registered category since then. And it's the biggest overall reduction overall when you consider eligible and registered since you go back to like the 1996 to 1997, 98 timeframe when you had a lot fall off. So we've had more deliveries as of late than we've had dating back about 24, 25 years when considered in total across both categories. So that's pretty astounding. We're going to go to a shorter term chart and we're going to show you what it looks like. Let's see if we can get this on the 3-month chart. You can see that we had about 400 million ounces when you combine eligible and registered on the COMEX. Now, most of those weren't for delivery, only the registered were, but the eligible, maybe you could have coaxed some of that out if you paid on a high enough price, but that was 400 million. Now in the span since February, since we had that run in LCV, really till about here. It was the end of February after, the silver squeeze movement, money rushes in SLV, pulls a lot of the silver out of the OTC market in London, puts it into SLV's coffer where they store in those depositories over there. Since then, we've seen about a 40 million ounce withdrawal net when considered both registered and eligible off of the COMEX depository. And most of that has actually been in registered. You see this going down much more than you see the eligible category going down. So a lot of it is what's available for trading is coming off, but combined about 39 or so million ounces, 40 million ounces, somewhere in there. That's a lot. And that's the biggest net since that 1996. If you go to that long-term chart, since about 1996, when overall inventories fell. Remember, since about 2000, when they created this eligible, is basically the overall stocks have basically gone up with a little blip there in 2011, right after the financial crisis, people taking delivery. So this is the biggest short-term move since we had in 25 years. And overall, it's beginning to rival. If you look there, about 150 million ounces to about 100, it's about the same as what we saw from about 2008 to about 2011. And we're not even in a financial crisis. Okay, so we're not in a financial crisis, but we're seeing silver pulled off. I wanted to make the point that that's a lot. So we're now sitting at 360 million ounces as calculated here at Gold Charts R Us, Nick Laird's site, a pay site, not affiliated with them, but I pay for it because I love the information. Highly encourage you to do so, to subscribe if you want. So all of that, coming off, again, we were at 400 million not long ago in this big move. The next big move was 2016 and then the financial crisis. So again, big moves. We haven't had that in a long time. That's a trend to pay attention to. All right. So the next thing that we want to talk about is, where did that silver go? Did it, because of the lowering EFP rates, or the difference between the price of silver on the futures and the London spot, COMEX in London, did it all go back to London? That's very difficult. So if you look at London stocks have gone up quite a bit. This is troy ounces in thousands. So it's gone up, it looks like to me, about 120 million ounces have come into the LBMA vault. This is LBMA vault holdings data. This is silver. From February to March, about another 120 million came in. Now, a lot of this is refinement. A lot of this is as the silver companies have recovered and started producing a lot more silver, it flowed back into the OTC market. It flowed back into vault storage in London. Not all of this, by the way, is available in the OTC market. It's just a net of what's sitting in their vaults. A lot of this is claimed by the the exchange traded products, the ETF funds and stuff like that. It doesn't mean it's liquid silver. So a lot of this reflects the increased demand in the exchange traded products, the ETFs, and not necessarily what came from COMEX. Net, if you look at all the silver that's gone into the exchange traded funds and what's come out of COMEX, it doesn't match. So we believe that some has been taken off of COMEX and just staying off of COMEX. And that's a big thing when you're pulling metal off the market. And that's the trend for you. And a lot of this buildup is the increased demand in those exchange traded products, exchange traded funds, and then also some private storage as well. Not all of it available to the OTC market, and certainly not all of it from COMEX. We've documented that in previous videos, some of those flows. I'm just summarizing that here. Go back and look at my previous videos for more on that. Next thing I wanted to do is look at silver deliveries. So leading up to May, this is deliveries right here. So we saw in 2019, a decent amount. And then, of course, in July of last year in 2020, based upon the increased deliveries I saw, I called the silver pop where it really started to move, and it moved quite a bit. I called it 2 or 3 days ahead of time when that price move happened. And then we haven't had that action like we had in July before, but we've had more consistent heavy deliveries. If you look at this range right here, from about August to about now, the amount of silver deliveries that have occurred on COMEX overall, and that could just be from one participant to another, but it stays on the exchange, has increased. So net, we've had more overall deliveries against a futures contract than we've had in quite some time. If you look at the chart, and if you go to like a long-term chart, let's do a 5-year chart, you can really see it. You can see since 2020, a lot more silver has been delivered. And when you add it to this chart, a lot more is being taken off. So it's not just passing from one participant to another and going into eligible vault storage. It's actually being pulled off the COMEX, and some of it's trading hands on the COMEX, but a lot of it's being pulled off the COMEX. And I think that we have described that there for you. So we've gone over all of that. The next chart I wanted to tell you, or the actual paper, is a Silver Investment Report 2021 on the LBMA. There's a lot to go over here, so I'm going to try to do that quickly. This appeared on the LBMA's website not too long ago. Here is the URL if you want it. We'll try to post this down to the description. It's on the Miles Franklin video I did yesterday. Elijah put that on there for us. But we want to go through some things, and I'm going to start down here a little bit. We're going to start at principal ETPs. So we're going to explain a little bit about what an exchange traded product is. So we'll start here. We're going to read these 2 paragraphs. At present, there are some 20 physically backed silver ETPs. In this section, we look at the largest products and the key issuers by location. The location often differs from where the silver is located or stored. For example, while the US is by far the largest market by silver ETP issuer, the UK comfortably dominates the physical storage. And that's important. Listen to the next paragraph. The largest ETP by some distance is US iShares Silver Trust. That's the SLV ETF. Launched in April 2006, and with 575 million ounces of trust as of the end of March, this fund accumulated or accounted for half of the global silver ETP holdings. It is one of the 3 products that are listed on the New York Stock Exchange ARCA. The other 2 are Aberdeen Standard products. So SLV dominates. And a lot of the ETPs and the ETF funds and stuff store it in the London market. Pay attention to that as we get further through the paper. So we're going to go down here. We're going to skip past ETP custodians. I've talked about custodians before, but I want to talk about something that they very interestingly put in this paper. And this is the paper I talked about on Sunday, but because I was doing a live where I was walking around, I didn't actually walk you through this on video to show you what it is. So I'm going to walk you through some key pieces here. So they talk about the social media storm. But before we get to that, there's an amazing thing here under the implications for another surge in ETP demand. So it says here, global ETP holdings hit a record high of 1.207 million ounces on February 2nd, 2021. I'm sorry, 1,207. That's 1 billion. As impressive as it may appear, it does not tell the whole story. As the social media frenzy gathered pace in late January, they're talking about the silver squeeze movement here. Demand for coins, bars, and ETPs all jumped. For the latter, the ETPs, global holdings surged by 119 million ounces in just 3 days. Now, remember, 110 million of that went into SLV on the last business day of January and the first 2 business days of February. We documented that. This was concentrated in the iShares fund, like they say here, which holdings rose by 110 million ounces. That's what we've said. Given that most of this metal was allocated in London, fears emerged as to whether there was enough silver should demand continue at this pace. Now, pay attention to that. It says most of this metal is allocated. Once it goes into SLV, it's allocated to SLV, meaning SLV, quote unquote, owns it. They've got their name on it. Okay. That means it comes out of the OTC, or the unallocated market. The unallocated market being paper derivative exposure to a limited number of ounces, multiple potential owners. So once you convert, in other words, unallocated ounces or ounces supporting the unallocated market into allocated, like the SLV, it affects the rest of all the other trade on the London OT market. Pay attention to what I just said as we go through this. So this is going to be a confirmation that the silver squeeze movement had a major effect on the London OTC market. They admit it in their own paper, printed on their own website right here at lbma.org.uk. Okay, at the end of February 2021, 765 million ounces was allocated in London against ETPs, leaving 360 million ounces of potentially available metal. Potentially, meaning lots of potential trade on there. And actually, some of it could be privately held, but we won't get into that. This suggests that had demand in iShares, that's the SLV, continued at the frenetic rate of late January, early February. Remember, 3 days where 110 million moved into SLV in 3 days due to demand from the social media storm, the silver squeeze movement. It would have only been a matter of weeks before London's existing stock was used up. So they had 110 million taken off, 360 million left over. Actually, I would say it'd be about 9 days, 9 or 10 days, not 2 weeks, be 9 or 10 business days. Because 110 million in 3 days, if that pace had kept up, it's going to eat up another 360 million in about 9 to 10 more days. While it would have been surprising to see ETP demand maintain this pace of buying, the concerns were still very real. This reflects both the time required for a refinery to convert non-good delivery material to 1,000-ounce bars. In other words, the London market is unallocated, and they're counting on forward production to meet current demand. That's what unallocated means. It means you don't have it now. You're playing the market like the EFP mechanism, COMEX, getting exposure to London market. It's all paper. But when you actually get down to demanding the physical, they don't have a lot. And that's the astounding revelation and admission in this paper. It is just astounding. We could go down and cover a lot of more things. I want to cover the social media storm here. The events of late January, early February have become almost folklore in the silver market. It is worth recalling how this emerged and its impact on retail buying even after the social media storm faded. In other words, they know that just because those 3 days have faded, the social media storm is there and it's getting stronger. All you have to do is go look at Reddit's Wall Street Silver channel and how many people they have and how popular that is. And then you see how many emails I get about it and how many comments on the shows I get about it and how many shows I'm getting invited to talk about it, how big this is, and it's not going away. It says, when the Reddit inspired, well, they go on to talk about GameStop and how this morphed into Wall Street Silver. I don't think it did. Wall Street Silver and Wall Street Bets being involved in GameStop and AMC and all those others, stocks, non-precious metal stocks, are completely different entities. So they're comparing Wall Street Bets and Wall Street Silver. That's not an apt comparison. Two separate groups of people, and I just wanted to point that out. So they talk about, as we get further into the paper, they talk about conspiracies. So buoyed by this success, social media discussions soon focused on silver, and in particular, long-held conspiracies that financial institutions were holding significant short positions. It's a conspiracy that they're holding significant short positions. Well, let's look and see if that's a conspiracy. So this is the Commitment of Traders report from CFTC.gov, the regulator's website, and I'm looking at silver as of April 20th, 2021. These swap dealers, which are financial institutions, bullion banks, hold 27.8% of all the short positions on the COMEX market. 27.8. And then you have another 16.85% in the managed money, which again is a financial institution. Put those together and you have about 28.3, add 16, that's 44% held by financial institutions. 27.8 on the bullion banks, 16.5 in managed money. It's right here in the numbers. So let's go back and reread that sentence. Buoyed by the success, social media institutions soon focused on silver, and in particular, long-held conspiracies that financial institutions were holding significant short positions. Gee, I don't know. Let's look at publicly published data by the regulator of that market in the United States, authorized by the government to track this. And we see over 40% held by financial institutions, managed money institutions, and bullion bank swap dealers. They're all financial institutions. Almost half of the shorts are there. Is that a conspiracy? I think not. But let's look at the concentration. Oh, we go back to Nick Laird's site, concentration of traders in the CFTC COTS. We look at silver here, the largest 4 and 8 traders. Look at the amount in terms of the traders. Look at the number of contracts. Gold and silver, the 2 most concentrated short positions on the exchange. Gold and silver, the 2 most concentrated short positions on the exchange. Gold and silver, the 2 most concentrated short positions on the exchange. I don't know how many times I can show that to you. I don't know how many times I can pull it out on a COT chart. But ladies and gentlemen, this is not a conspiracy theory. It's in publicly provided data by the U.S. government, regulatory agency CFTC, which is the one that manages this. So they go on to talk about conspiracies and blah, 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 and all that good stuff. At the end of the day, it's not a conspiracy. It's on government data. Again, CFTC report, cftc.gov, April 20th, 2021, silver. Okay, got it. I don't know how else to show that to you. Aggregated data in terms of number of contracts, gold and silver. Look at those positions, largest 4 and 8. I don't know. I don't know what else I could even show you there. Let's look at days of production. So U.S. days of production adjusted by sector. So let's see if we can load that chart. Gold and silver, largest 4 and 8 traders. More than palladium, platinum, copper, crude oil, cocoa, coffee, cotton, sugar, corn, rough rice, soybean. What other commodities are there? Okay, long-held conspiracy. Let's look for conspiracy again. Long-held conspiracy, financial institutions were holding significant short positions. Gee, I don't know. Is that significant? It's so much higher in the precious metals than any other of the regular, the EFP crisis. And they go on to say that when there's a price differential, it sucked metal over to COMEX because it actually pulled metal. This actually proves my point that you can take delivery via EFP, or you can actually force metal to move via EFP. I've said many times, EFP is not just for price arbitrage, okay? EFP also can pull metal off of the London market, because when people get really long EFPs and COMEX, it pulls the metal. That's the net effect. They go on to talk about that in this report. As a result, both gold and silver traders are forced to buy back contracts. They cannot make delivery, and so EFP premiums on both metals jumped. For silver, EFP remained volatile. Following the late March, early April peaks, both EFPs remain elevated. Ongoing heightened risk concerns, reopened logistical companies, and so the metal came over. So the attraction to both gold and silver. Second, the attraction to deliver both gold and silver and COMEX depositories reflect the going arbitrage opportunity at the time. What I have said over and over and over and over again, when you have an arbitrage opportunity between the 2 markets, yes, you can actually pull physical silver. The LBMA, which manages the London side of that EFP contract, is admitting it in this sentence I have highlighted on the report on their website. Not conspiracy there either. All right, I've beaten that with a dead horse, but a lot of you wanted to understand how EFP worked. I gave you the data. There we go, and I've given you the statistics. Now, I want to get something super interesting. We want to get into the regulator and some of the legalities, because this has come up in some private topics of conversation. There's one gentleman, very well, somewhat prominent in the space, has a prominent position anyway, but maybe not as well respected as he believes himself to be, who has made some disparaging comments on his channel. I'm not even going to edify those and tell you where they are. Feel free to go find them. But basically saying, we have another conspiracy theory that I'm saying that the CFTC Commissioner Rostin Benham didn't say what I said he said, and what I talked about last Sunday about them controlling the price and volume of silver last February, as we had the silver squeeze movement and the rush into the SLV, and therefore the aforementioned pool of the metals out of unallocated to allocated, I showed you earlier in this very presentation. So I'm going to play the section where Rostin Benham on video, in his own words, at the Boca V conference, the FIA, okay, International Futures Conference, says that exact thing and says more astounding things. I'm just going to play this for you. Actually, what I have to do is I have to share with sound. So let me reshare this with sound so that you guys can hear it. There we go. We're going to share with sound and listen to what the CFTC Acting Chairman Commodity Futures Trading Commission, Rostin Benham, says to moderator Walt Lucan at the Boca V conference, sponsored by, I don't know, CME Group and these other entities. Hint, hint, hint. All right, Let's listen.
See. Yeah, thanks, Paul. It's a great question. It's something that I've been thinking about, and the events around the silver markets happened shortly after I took over. I think in late January, and I think it's important to distinguish what an equity space with what happened in our markets in the future space, specifically with the silver contract. And in many respects, the resiliency and the market structure of the futures market really were able to tamp down what could have been a much worse situation in the silver markets. And
so the infrastructure of the markets tamped down what could have been a worse situation in silver. What was the situation? Metal was being pulled from unallocated in London to SLV into an allocated state, threatening to bankrupt the London OTC market, getting close by the LMB's own admission, and the price was getting close to $30. That's what the tamping down was. The market tools, which he'll talk about here in a moment, that the CFTC has and the exchange has, were to tamp down the movement of those metals and the price rise. Listen further.
Just pointing to a couple things that I've observed over the past couple of weeks, and I shared with my colleagues within the U.S. government, and that are either unique to many respects to the equity space entirely. We have sort of history and precedent in the future space. We have a match order book, don't have rules. We have T+1 settlement. The clearing infrastructure as a general matter historically within the future space is built in and very strong. Initial margin, daily mark to market, position limits. All of these things together, I think, really were very effective in managing what was at some point in those few days in late January, potentially a challenging situation, and give credit to the exchange for utilizing its authority and some of the tools it has within the margin space to control the sort of the price and the volatility of the silver contracts. But I think.
Okay, he just said the exchange controlled the price and volatility of the silver contracts. In other words, the exchange used all those market tools he just said that they had to control the price, the volatility, the volume of those trades on the exchange. Is that not intervention by the regulator? That's intervention by the regulator admitted by CFTC Chairman Rostin Benham.
All those things together are important elements, markets that both sort of, transparency, resiliency, credibility, as we talked about in the sustainability space, that make our markets very, very resilient and strong. And
so notice all the buzzwords he used there: transparency, credibility, sustainability. What does a market intervention by the market regulator have to do with those? But see, guys, I think this is the way they think. I think they don't see the market as benefiting the individual trader. They see the market as benefiting, I don't know who. Maybe those financial interests, as we see, that conspiracy theory around the financial interests who have these shorts, 44% shorts, according to the COT report, and the largest 4 and 8 traders in gold and silver. Silver was a market he was talking about. It has the largest 4 and 8 concentration. Those tools were to reduce volatility, control the price. Who had the biggest, the most to lose by that silver price rising? I don't know. Was it the largest 4 and 8 shorts? Those financial institutions that the LBMA says is conspiracy theory, but the CFTC reports say is not. So those CFTC reports that this gentleman is the chairman of say that you have those concentrated short positions. And what he's saying is essentially we needed to control that, basically protect them. In other words, if you read between the lines, they needed to control that to protect the interests that are in the market, in particular the bigger interest. They're not looking at the little guy here. And I don't believe Mr. Benham believes he's doing anything wrong. I think he's doing what the market was set up for. It was set up for the paper trade to allow these financial institutions to trade, to arbitrage, to make money on this. It was not for the small guy. It was not for us who own silver or the farmer producing wheat or whatever the case may be. It's not for us. What he's saying here is this market's for the big guys and not the small guys. That's me reading into what he's saying, because I don't think that the guy would honestly come out with this admission on the public airwaves at an international public conference unless he believed what he was doing was legal, ethical, moral. I just don't think he would. I think his view of the market is much different than what we all view it in, and that's what I want to get into talking about. You can listen more to what CFTC Chairman Rostin Benham says But I think it's clear just from that excerpt what the gentleman believes and how the market makers see you and me. So if you expect as an individual trader, even if you're a farmer, if you're a producer or a merchant, one of those small guys, right? Maybe some of the other reportables that people trade in the market that are maybe individually well-to-do, but they're individuals. That market ain't for you, it's for them. And that's why they used all their market tools, like he said, to control the price and the volatility. Because who would the volatility have hurt? Gee, I don't know. Would it have been the largest 4 and 8 traders in the silver market, which are, according to the CFTC COT report, the financial institutions, which you can see right here, that belong, the swap dealers, which have 27.8% of the shorts, the managed money, such as hedge funds and others, have 16.5. Together, concentrated 4 and 8 have almost 40% of the short positions. That's who he's protecting. That's who he believes he needs to protect the integrity, the transparency of that market. That's why you use those buzzwords. So just want to show you who this market's for and what the CFTC is regulating and who they're here for, okay? And what they're here for. They're here to ensure that those financial institutions get what they want out of the market, and they smooth the price and get rid of the volatility and use other market tools to do that. If us retail traders, enthusiasts, and people who own, in small little amounts, and there are millions of us, actually want fair price discovery. That's what he's saying. And that I found to be an astounding admission for 2 reasons. One, that he actually said it, but 2, he doesn't have the cognizance to understand how that's going to appear to the many. Yeah, I mean, I'm sure it's music to the ears of financial institutions and the government, which he said he had been addressing during this whole silver squeeze movement. But that's the government and financial institutions. The markets are supposed to be here for us. This is a republic. And, the law is supposed to protect the individual. That's what a republic is, not the large financial institutions. So I just want to make that point. We're going to get into some legalities here because there is this insinuation from certain people in the market. By the way, one of them, which has sponsored this conference, and may happen to have their name down here. I'm not going to tell you which one, and some others that don't have their name down here. Insinuation that, gee, I don't know, that the silver squeeze movement, the small retailers, the enthusiasts are into the market because, and into the market and then potentially manipulate it, and they're the enemy. I want to address that a couple ways. One, I've written in financial media for about 12 years. I was on Seeking Alpha. I was syndicated across a lot of major outlets, Yahoo Finance, Financial Sense, Talk Markets, NASDAQ.com, MarketWatch.com, many others where I got invited to or my information was syndicated. And the whole purpose of those websites is to talk about what you believe in, what you like, what you're enthusiast in, what you analyze. And everybody has their sort of fields, right? And we talk about stock portfolio allocations, and we talk about the Apple fanboys, and we talk about people who love Tesla or hate Tesla. That drives the entire financial industry in the United States and across the world. So to say that people getting together liking silver on a Reddit page is any different than that, which drives the entire financial sector, is utter bullshit. Okay? It's utter bullshit. And that is not collusive market behavior because it goes on in every market every day, and they encourage it in those other markets, just not gold or silver. Why? Because you have these traders short silver and gold, largest 4 and 8 positions, and it may affect them. Okay, it has to do with them, not us. I want to make that point. All right, now getting on the legality. So in the Constitution, why is it important to have real price discovery for gold and silver? Well, I'm in the Constitution right here in archives.gov. Okay, that's a government website, the National Archives, archives.gov, straight from the government website. I pulled this one in particular on purpose. Section 10, no state shall enter into any treaty, alliance, or confederation, grant letters of marque, enterprisal, coin money, emit bills of credit, make anything, thing with a capital T, anything, but gold or silver, coin with a capital C, in tender with a capital T, in payment, capital P, of debts with a capital D. The capitalizations are legally significant because they come with very specific meanings. You don't coin anything other than gold and silver as money. And that's in the Constitution. And I don't care what law you pass, the Federal Reserve, all that stuff. It's unconstitutional because Congress does not have the right, and the Supreme Court has said this, to vote a law in which contradicts a section of the Constitution, okay? And they also have limited ability to amend it to contradict a section of the Constitution. A lot of people don't know that. You can't just throw any amendment out there you want either. Congress doesn't have that power. The Supreme Court has said that over and over. And they're saying here in Section 10, No state, meaning the federal state, nor the states underneath it, the 50 states we now have in the union. That's what state means. If you look at the definitions of state in legal terms in this code, if you go to definitions, actually in the USC code, but that's also what they meant when they wrote it, because the founders wrote papers, and that's what they meant by state. They meant the federal and the state level. Okay. No state should make anything but gold and silver coin a tender and payment of debts. Okay. Period. Okay. So that's why gold and silver are important. And that's why when you have a fiat currency, you see the biggest concentrated 8 and 4 traders in gold and silver, because according to the Constitution, that's true money. And when you have this gentleman from the CFTC admitting that they used all their market tools to smooth volatility, cap the price of silver as it was moving up, and control the trade, in his own words at an international conference, that becomes unlawful in constitutional terms. Now, I don't believe the gentleman did this on purpose. I'm not trying to say he's knowingly a criminal. What I'm trying to say is I don't think he understands that, because he's grown up in a world that's based upon all the statutory law that's lost sight of this Constitution and the importance of gold and silver, and has lost sight of the fact that we really need free markets, not controlled markets. Even though he believes he's doing it for good reasons, I think he's lost his way, his understanding. So I want to make that clear. I'm not trying to say he's trying to do something illegal. And I made this point on Dunnigan's program, which you'll see hopefully on Friday when it comes out. I think they think they're doing the right thing. But I think in reality, if you look at the law, it's unlawful. All right, now, going to 7 U.S. Code 9 here on Cornell Law School, we want to talk about manipulation. Prohibition regarding manipulation of false information. And they're talking about commodities, because you see swaps, commodities, interstate commerce. Prohibition against manipulation. But I'm going to come down here to other manipulation, part 3, okay? In addition to prohibition in paragraph 1, which is the one we see here, where they're talking about swaps, contracts of sales, registered entities, all that stuff, and they're defining who people are, what a person is, what a commodity is, it says this: in addition, it shall be unlawful for any person. Gee, I don't know. Is Rostin Benham a person? I believe he's a person. It shall be unlawful for any person, directly or indirectly, to manipulate or attempt to manipulate the price of any swap or of any commodity in interstate commerce, or for future delivery on a subject to the rules of any registered entity. Okay, now, if you're the CFTC commissioner and you're using market tools to do this, and the people under you are using market tools to do this, okay, is that a person? Yes. Are they covered here? Yes, because they're the regulator. And is that person in that concentration of people running the regulator with all these tools that the rest of us don't have, do they have more power to manipulate? Do they have more ability to manipulate? Do they have all these tools that he said he used to manipulate? Do they have more tools? Yeah. I can't use position limits. I can't enforce position limits as an individual trader. I can't do that. Even if all of Wall Street people, Silver's people got together, we can't overrule the exchange and the CFTC regulators on use of position limits and all of those things that he talked about, all those tools. We don't have that right. How would we manipulate the market? They've got all the tools to manipulate the market. And this gentleman just said in the video, that's exactly what they did. Okay. So that manipulation, whether intentional or not, lawfully, not only is it illegal according to the Constitution because it's money and you're not supposed to do that, but it's specified right here in 7 U.S. Code 9, right here on the Cornell Law website, right there. Okay. And right here in section 3, it should be unlawful for any person, directly or indirectly, to manipulate or attempt to manipulate the price of any swap or of any commodity. Rostin just admitted doing that. I don't think he understands this, and he's the head of the CFTC, and that's just astounding. How do these people get to the head? So let's talk about what is manipulation. Is our enthusiasm, by the way, which goes on in every market, Tesla, Apple, your favorite car, your favorite sports team, because you like bonds, because you like a specific commodity, it goes on in every market. Is that enthusiasm and that grassroots effort manipulative? Well, let's look at the definition of manipulate. So manipulate, to handle or control, typically in a skillful manner. Where the retail traders are the least skillful because we don't even trade on the exchange. We're not the big houses, and we're not protected by rules and tools promulgated by the CFTC. So we don't have those tools. The CFTC has the tools and the mechanisms. We don't have the tools, okay? The second definition, to control or influence a person or situation cleverly, unfairly, or unscrupulously. Were we controlling the situation individually? No. As a group, were we controlling it? I would say there was demand, but was it done unfairly? No, we used the market mechanism. They used SLV, which is promulgated, okay, for the purposes of giving a derivative exposure in a fund format to silver. And SLV had to buy the silver ounces because that's what the prospectus said. There's nothing unfair about that. And it's not unscrupulous. Why? Because I'm going to read for you the definition of unscrupulous. In a way that does not show moral principles or is not honest or fair. How is it not fair? They just bought shares of SLV. They're in the public. You can create as many shares of SLV you want. It's not a closed-end fund. And they don't say how much you can or can't. There was no violation of how the SLV worked, because if there was, the SLV would have stopped it and said that's an illegal trade, or it goes against our rules, maybe not illegal, but it goes against our rules set about in our prospectus and in our policy documentation. So no, it was a bunch of little people saying, we want to buy silver because we believe in silver. Why? Because it's money according to the Constitution. It's money. It represents real value. It's lawful to go buy as much gold and silver as you want and can afford because it's money. So what legal precedents would anyone have for saying that the Wall Street silver movement, the Redditors, the silver squeezers, or anybody, including me or anybody else, is violating law and buying the SLV and buying a silver physical ounce and buying a silver stock, or any other way in which we choose to participate as individuals? Because if you made that stretch of an argument, you have to say anybody that bought Tesla or anybody that bought Apple could be accused of manipulating Tesla and Apple, or anybody that bought Microsoft could be accused of manipulating Microsoft, or anybody who just went and bought wheat and created excess demand for wheat because they wanted to feed their family was unscrupulously affecting the market and had intent to do that, according to the law here at 7 U.S. 9 on Cornell Law's website. I wanted to get into legalities because people who say it's unethical for people to do things like silver squeeze, that means it's unethical for you to tell anybody else that you like Tesla and to unduly influence them and to build a community. You know, and at what point does that stop? What about the value of sports franchises? If you like the Dallas Cowboys, I happen to live in Dallas, and all of my friends get together and we watch the game, we wear our gear and all that stuff, and it causes the value of the Dallas Cowboys to go up to $2 billion. Is that unfair to the rest of the teams? No, that's how it works. That's what they want. That's how all the financial markets work. I don't care how you do it. Okay, there's nothing unfair or unscrupulous about that. So I've gone on a little bit of a rant here at the end because I wanted to talk legalities. I wanted to show you legal proof according to the government's own websites. And I also wanted to show the statement by CFTC commissioner to show that if anybody had the tools to manipulate and do it cleverly and ability to affect the market, it would be them, not us. The individual can't, even if we wanted to. Now, if we do it en masse because we believe in it, that's okay. But that's what people do across the financial sector. It's called demand. It's called aggregate demand. It's economics. Okay. When people see their money printed to oblivion, okay, and they see the value dropping, they're going to put money in things that matter. Now, is it manipulative in gold? Only 0.5% of people in the US, according to statistics I see quoted every day, own gold in physical form. How could you possibly say that the individual investor was manipulating gold? Okay. And they don't have the size to get on the exchange markets and buy the 100-ounce gold bars or the 5,000-ounce silver bars. We don't have the money to do that. And if you're just buying a few shares at SLV, and a lot of people are doing that, how is that unscrupulous? How is that using a tool? You're not using a tool. You're using the market mechanism that everybody that has been put forth as the legal market mechanism. No, it's really sour grapes because people are using market mechanisms to build their positions and to hedge the government printing of money and things that they see are problematic and to make investments. They're using the tools put before them to say that are legal and ethical to do that. And it's the people that have those tools at the top, like the CFTC, the CME group, and others that run the exchanges, or the financial institutions that have those large concentrated positions, which have the ability to manipulate. It ain't us. So if you're going to come after us, I've set the legal precedents to defeat that argument. I did it on purpose. If anybody calls me, I'm just going to point into this video and say, I'd like to see you try to prosecute. And the reason I do that is because the CFTC has issued a press report in which they're stating that they're watching the retail traders for the potential of some sort of market malfeasance or manipulation. That's what they said in their words. And I think I've showed that release in previous videos, but you can just go to Google CFTC and you'll see it. I think they released it, it was sometime after the run up in silver in February. After, by the way, the CFTC controlled the price, the volatility, and the volume on COMEX, as per Rostin Benham, admitted in public on that video, can't take it back. I've now got it video here, can't take that one back. He just admitted. And he said, oh, I was talking with the government about what we did, to explain how we controlled that market. Okay. Why would you control silver? Constitution, it's money. It damages the credibility of the fiat dollar system and of our current financial system. Now, if the fiat dollar dies, could that cause a lot of pain for people? Yeah, but fiat currencies die all the time. That's the history of fiat currencies. It doesn't mean that you go persecute the small guy for trying to turn his declining, horribly valued dollar that's more and more worthless every single day for something of actual value, and gets tired of you manipulating that darn market, to affect the value that he has in constitutional money. And the only thing that they can go to when you print so many dollars in the government, that you drive them out of anything else. Okay. All right. I'm going to stop it there. This has been a long video. This is leading up to the 10th anniversary of the May Day massacre in Silver. We're going to come back Saturday. We're going to do a live. I'll go as long as I can there giving coverage. I wanted to do this for Silver. It's not because I'm trying to manipulate the market or get everybody to do something unscrupulous. We're doing it because we want you guys to have the information. We support it. But again, there's only a small percentage of us across the world that actually invest in the metals. Is not collusive. It can't be. We don't have the power of the market makers. We don't have the power of the market regulators. They have the power. We're just trying to put our money into something honest using legal tools that have been set up for us. And if you don't like that, then I guess you have to go to Congress and make it all legal. Just make the whole complex of trading on silver or gold illegal, make the EFPs illegal, make it all legal. Because that's the only way you have a standing lawful argument that we're doing anything wrong. And I think it's the reverse. And I wish people like Ross and Benham, who I know means well in his way, in the way that he was taught the markets, I wish he would realize we're a republic. We protect the rights of the small guy. Gold and silver is constitutional money. The fiat dollar is dying. Stop hurting people by manipulating those markets. I know he's not doing it on purpose, but you got to realize and you got to stop. I hope he sees this video. I hope he realizes our perspective, because we matter. We're why the government is here. Okay, it's us, we the people. That's the way the Constitution starts. We the people, not you, the CFTC, not you, CME Group. Okay, not you, the exchanges, not you, the big financial centers. We the people. All right, we the people. All right, that has been the May Day Massacre special. Silver's being ripped off the COMEX. It almost got completely ripped off the LBMA, the actual physical. We'll see what happens when May occurs. And the whale is going to be the people, we the people. It's going to be the retail investment that says we want a little bit of silver and gold. And it ain't going to take a lot of us, because there ain't a lot of it around. And that's why it's super valuable. It's not going to be 95% of us all colluding to break the market. We'll be lucky if we move from 0.5% of investors in the US to 0.6. And that could bankrupt the system. That's how little actual metal there is. And that tells you everything you need to know about the value of gold and silver against the value of everything else, stocks, Bitcoin, the dollar, the debt, all of it. That should tell you everything you need to know. All right, till next time, this has been Rob with Gold Silver Pros. Thank you for joining my channel. Oh, by the way, hit like and subscribe. Go to the website. If you subscribe there to our subscription content, you get the Golden Quarterly, you get the Gold Silver Pros University, you get a copy of my book, the calculators, and lots more. And we support you there as well if you're interested. Thank you so much, guys. Till next time, this is Rob. Hey everyone, this is Rob Keens of GoldSilverPros.com. It is Thursday, April 29th, 2021, and today I have a very special presentation for you today. A lot of my subscribers have been pinging me and bugging me and emailing me to write about the uranium sector, and I've kind of held off because I have looked at the uranium sector before. I covered it when I used to write for the online financial publication Seeking Alpha, but I feel as though now is the time to go ahead and introduce this to you guys, because I think the fundamentals in uranium are getting stronger. And while we are Gold Silver Pros, we do cover other areas of the investment world as well. For example, if you're a subscriber and you go to Gold Silver Pros University, we cover the general economy, the general stock market, as well as real estate. So we do like to cover other areas and provide potential values for you. So we are going to grant the wishes of many of my subscribers, and we're going to get into uranium. I'm going to start by talking about the overall fundamentals. I'm going to give you a nice OECD report from 2020 that gives us the short and long-term picture. We're going to talk about uranium price fundamentals, and then I'm going to offer you an opportunity of a company that I'm bringing to the channel that I think is very unique in the space and different from the rest, and you'll see why here in a moment. So let's go ahead and get into the presentation. I'm going to go ahead and share screen, and we're going to start off with a chart of uranium. So this is a uranium chart, long-term 1990 to 2021, as you can see here on Trading Economics. And they track the OTC and the futures price here in this chart. And you'll notice a couple of interesting things about this chart. We saw a low uranium prices up until the early 2000s, and then it spiked here in July of 2007, I'm sorry. It came down and then it spiked back up again the beginning of January 2011. I'm going to explain what those spikes are with a little bit of data here, and then we're going to talk about the fundamentals of uranium now. Here's where we are in price, but where do we think that price is going to go? So when the uranium price spiked up the first time on this chart in this time frame, it was June, July of 07. Uranium spiked up because there were expected resources to come on and a very big project that didn't come on. There was a flooding at a mine. Those resources got delayed. It took a long time for that mine to get drained. The uranium price had already started to rise. You can see it rising 2005 all the way up until this point, 2006, 2007, when that event happened. And then that's when it spiked. So uranium was already on an uptrend due to world demand. Then you had the potential supply coming on that people expected to meet it, and that didn't happen. So here is a nice reference at uraniumseek.com from Andrew Mickey, Chief Investment Strategist, published back on August 22nd, 2008. And he goes on to document what happened. It was a flooding at one of the mines for Cameco. The world's largest uranium producer, Cameco, was banking on pumping out uranium from its Cigar Lake mine, and that was the only way for it to capitalize on rising uranium prices. That's an important point we'll get here in just a moment. Cigar Lake was going to be massive, and the mine was expected to provide as much as 17% of the world's yearly uranium production. However, a retaining wall collapsed and the entire mine flooded. Cameco confirmed a single pound uranium wouldn't come out of Cigar Lake for at least 5 years. And so that caused the bubble to continue to grow. What was a small bubble we see here at the beginning of this uranium uptrend turned into this major bubble here. And eventually they got that sorted out. According to World Nuclear News, 12th of February 2010, Cameco had completed the draining of the Cigar Lake, so that took a couple of years for that to occur. And then that's what we see on the price chart. Price starts to come down at the very beginning of 2011, and so on and so forth. So the market was reacting to that. So now we have the other price spike to explain what happened here at January 2011, December 2010, when we saw that other high in the uranium price, and that is explained through this report from the OECD, Uranium 2011. I'm not going to read the whole report for you. It is long. As you can see here, it's 489 pages. But I did read through this report, and the reason the price was spiking in 2011 was due to both an increase in demand for uranium and increasing costs for getting it out of the ground. I'm not going to go over all the details of why it increased in cost, but it was increasing in cost. And when you have demand going up and an increase in cost in getting uranium out of the ground, that's what causes uranium price to go up, and that's a natural market. So both of these were natural market events. This was a short-term event that occurred over a couple of years for expected uranium production from a Cameco, Cigar Lake. And then you saw the spike here in 2010 due to increases in prices and increases in demand at that time, as a lot of reactors were being built and nuclear reactors were being built, and the demand for uranium had gone up. So that explains those fundamentals. Now we're going to get into a little bit of a longer term over why I think uranium is in a bull market right now and why it's potentially a really good investment. And then we're going to talk about the company I want to bring to you today, which is really safe and great way to leverage that. So in this OECD report, Uranium 2020, Resources, Production, and Demand, we have a few charts that I want to show you guys. So we're going to start here on page 17 with known resources. And we're just going to outline resources, supply, and demand, and where that's expected to go in this report. So as we get down here to page 17, I want to show you what it looks like. So get one page up, and that's the chart we're looking at. If we go up here, it is the distribution of reasonably assured resources among countries with a significant share of resources. So long term, this is the countries that are involved in what their resources are at the different grades. So you can see the grades here in the upper right-hand corner. They're color-coded, and then you can see who has them. Now, that doesn't mean that that's near-term production. That's the reasonably assured resources. What we think we have available in the ground that we can get in a reasonable time frame. That's a very important chart because it tells us what we have in the near to the medium term without making some additional discoveries. So that outlines for you what it looks like across the world and which countries have those. Now we're going to jet down to page 39 here, and we're going to look at another chart. And on 39, we have this really nice chart in trends in exploration and development expenditures. This is very key to the argument about why uranium may be getting more expensive and the price may be going up. And we did see on the chart, as we go back over here, we did see a nice little rise in the price of uranium since 2016 from about 20. It touched on about 32 at its high, and it's trading about the 28, 29 range. And the reason is because about, or preceding that, at about 2014, you had the domestic and the non-domestic at the same time, exploration and development expenditures fall. Well, why was that? It's a combination of demand and supply and how much uranium we need. And so there was some needed supply destruction or stopping of mining activities because there wasn't enough demand to keep that price up. The price had come below the cost to mine the uranium. And so you had supply destruction. You had people just closing the mines temporarily and not spending on additional exploration and development, and you saw this come down. So this is important because this trend has been going on since 2014 through 2019 here on the chart from the OECD, which means we had not been producing enough uranium for future demand, fast forward today in 2021. So that was a natural effect of the market, demand destruction short term. But what that meant was leading into 2020, 2021, with the increased demand for uranium, we didn't have enough supply because they had stopped producing for those reasons. So now we're going to go to page 57, and we're going to look at another chart here from the OECD, and we're going to see uranium production. So you can see the production and who produces it. 41% Kazakhstan, 13% Canada, 12% Australia, 10% Namibia. Now, Australia has the biggest reserves, but they're not, again, producing all those reserves. So again, when we're looking at actually who's producing versus reserves, just because they have a lot of reserves doesn't mean they're actually putting out all of those reserves. There needs to be an incentive for them to do that. There needs to be the appropriate price point for them to restart the mines and get that production out. And so that tells you that Kazakhstan's producing a lot, but Australia is going to have to step up when the new demand comes, and other countries as well. And that production is not online. So for those of you looking at the supply demand side, when you're prospecting for your investments, this tells you that while there is supply there, it's not readily available at this particular moment. And as we have demand, that price is going to come up to meet that demand. That's basic, economics 101, if you will. Then we're going to go to page 71. And there's an interesting thing in this report from the OECD on page 71, and this is idled mines. So I wanted to show you the idled mines chart. These are the mines since 2013 through 2018 that have been idled. So when we saw that chart earlier in the presentation about the supply destruction because of the price demand fundamentals, these are the mines that basically had been idled at that period of time. Now, can they come back on? Sure, they can. There's going to be expenditures in restarting those, hiring people, getting the mines running. It's not going to happen right away. So there's going to be that period of time which you have the increased demand, and then you have to restart some of these mines. And some of these companies may not be ready to restart their mines. It depends upon their individual financial situations and characteristics of those. So you can't expect all of these to just come right back on and reboot and push the Staples easy button and get that production out. So again, that's where I think that we have a short-term opportunity, and then there's a longer-term opportunity, which we're going to show you here in a moment. We're going to go to page 77 now, and we're going to look at world installed nuclear capacity. For those of you that want to know what that was, as of the 1st of January 2019, it was 396. I believe that's gigawatt net in North America. Has the most installed, 114. Then you have European Union, 117 the most. Then North America, 114. Then East Asia, 106. Then non-EU Europe, 44, Middle East, so on and so forth. So that's the overall installed capacity. So that would be who would use that nuclear capacity. So for those of you stateside that are wondering, does the US use a lot of nuclear energy? The answer is yes. They're second in the world. European Union's not the only one. We're almost caught up to the European Union, at least as of January 1, 2019, the latest available stats from the OECD. And then, of course, you got East Asia. And then you got non-EU Europe, which is some Eastern European and other countries. And then you got the Middle East and so on and so forth. And the one here I want you to really pay attention to, if African economies ever really get to that point in which they're building a middle class, some of them already are, but I mean, as a continent as a whole, this number could really explode and the demand for nuclear energy will go up. That's more of the medium to long term, but I did want to point that out. That is definitely a possibility for those of you looking more long term, although probably not in the next few years. So now we want to go to something environmental. What is the case for nuclear from an environmental perspective? A lot of people think nuclear is dirty energy, but here there is a chart on cumulative CO2 emissions avoided by nuclear power in selected countries from 1971 to 2018. So we know that the largest users of nuclear are United States and European Union, and because they're the largest users, you see the most carbon emissions saved. So if you're in particular concerned about carbon emissions and all the law that goes around that in terms of making your investment decisions, then here is a nice little chart that shows you if those countries' policymakers are wanting to go green, uranium is a good way to do it because it reduces cumulative CO2 emissions over other sources of fuel, especially the fossil fuels. All right, so I wanted to show you that chart. That is if you're in the green movement and that is important to you, and certainly even if it's not, but it's important to the politicians in your countries, or if you're just looking at the demand profile for nuclear because you know these politicians want what they consider green energy, that chart is an important factor in making your decision. Okay, we're going to go on to the next one. Projected nuclear installed capacity here on the next page on 91. So we'll go to page 91. Here's the installed nuclear generating capacity world total. And you can see that it's been a nice increase, expected increase to 2040. So they're expecting in 2020 to be 387 world total. As you look down here, they're expecting by 2040 this to go to 626, and it's steadily rising. So the low and the high for 2020 is 387 to 402. But as you get up into 2025, 2030, 2035, long term, they know, OECD knows you can't replace all the energy generated by nuclear given fossil fuels and other fuel sources, especially solar and wind. It just does not produce as much energy as nuclear. And that's why over the longer term, again, we're expecting the demand for nuclear to continue to go up. Okay, a couple more charts here. We're going to look at a world uranium chart. Let's look here on page 96. We're looking at annual uranium production and requirements. One of the reasons price is going up and why we expect it to continue to go up is because world production, this dark blue line, has fallen, but the world requirements has gone up. So there was a period of time in which uranium price had fallen, that 2013, 2015 range, when you saw that supply destruction. And what's going to happen is now you have supply demand. So you're going to have supply coming back online. In the meantime, while it's coming back online, you're going to have higher prices. Why? Because the world requirements in 2019 have gone up, but the capacity to produce it has not yet been brought online. Why? Well, that's what I said earlier. It takes time to do that. And each individual company has to make their individual decision based upon the economics of their deposit, how much money they have, the investors that they have, and so on and so forth. So what we want to do is find a way to play this market that takes advantage of the price increases without exposing us to any individual company's individual financial and economic situation. And that's key to the company I'm going to be talking to you about here in a moment, because I found a way to do that for you guys. And I think it's a safer and a better way in the long term with higher returns. One last chart here from the OECD, and you can see cumulative uranium production and requirements has gone up from 1949 to 2019. This is a long-term, what is that, about a 70-year chart. So not only did it go up from 1949 to 2019, but they're projecting out it to go out to 2040. And again, that's because they know, the researchers know, and the policymakers know, we haven't found a way to replace that energy. It also replaces a lot of CO2. So if you've got requirements to reduce CO2 because of climate treaties and things like that, and you need to replace energy that solar and wind can't, and we're harder to find the easy to find oil and gas, you've got to come up with a way. And uranium really is the best answer for a lot of people. That's why I expect uranium to continue to be demanded more. All right, so now we've gone through that report. We've gone through all the charts from the OECD. You've got the short, medium, and long-term demand and supply, and we know that the price is going to go up. So how do we play this? Rob, how do we play this without exposing ourselves to any one individual company's individual situation in a way that's safe, but gives us leverage to the actual uranium price? And I'm going to show you that. So the company that I want to bring you is Uranium Royalty Corp. Now, remember from earlier in the week, we talked about gold and silver, and we talked about Sailfish Royalty and gold and silver, because they are a royalty company, a good way to play gold and silver more safely if you don't want to go research all these individual companies, but you still want exposure. Well, for the first time in uranium, we have a royalty corp taking advantage of that same model that you see in the precious and the base metals that allows you to get exposure to uranium without necessarily being exposed to all the operating conditions around all those individual companies. So Uranium Royalty Corp trades on the TSX Venture Exchange under URC, and under the NASDAQ under UROY. So if you're in the US, you can get them on the NASDAQ, the Toronto Stock Exchange in Canada, URC, and those are the tickers there for you. Now let's get into the advantages of this company. We're going to spend some time doing that. So I want to talk about management and directors. Amir Adnani, many of you know from the uranium sector, director of Uranium Energy. Let's expand out his profile. Uranium Energy Corp. Now, I know them because I have met them at conferences. I first met their company at Vancouver Resource Investment Conference in Vancouver a few years ago, talked with their management. And this company, the one that he runs, Uranium Energy Corp, has assets in Texas where I live. So I was very interested in that because I was interested in local resources for uranium. So I followed Amir for a long time. He speaks on the concert circuit. He's very successful. He's chairman and director of the company, very, very well known. You have Scott Melby, the chief executive officer, president, and director. He has been a director of the company since April 2017, chief executive officer and president of the company since October 2019. He's very experienced, 35 years experience in nuclear energy industry, leadership positions in various uranium mining companies. So you're already talking about a company which has major leadership that has done this before, has the experience. He was previously as a vice president of commercial at Uranium Participation Corporation, chairman of Kazatomprom, national uranium company in Kazakhstan. Remember, they produce a lot of the world's uranium. So this guy knows the uranium market around the world. Now, if you're going to run a royalty company, you want somebody who understands uranium company around the world. That management is so key, and they've got it in Scott. They've got other people here that you can look through, if you will. David Newberger, Veena Patel, Neil Gregson, very, very experienced in finance, in uranium, in mining, in this sector, a very, very experienced team. I wanted to highlight that. The team matters. If you guys go to Gold Silver Pros University, if you're a paid subscriber on my website and you go through the mining stocks section, I have a whole article on how to value companies, and management is my number one factor over success of the company. And this team has it in spades. They have the managers that you want. First thing I look at, pass this with an A+, just in my opinion. They do have analyst coverage. I want to point that out. So this is a well-to-do company that is covered by analysts in the market. This is not a small company, which is just getting their feet underneath them. They have coverage and they've been successful. They have a nice share price, and they're being covered by Canaccord. They're being covered by H.C. Wainwright & Co., by Paradigm Capital. So if you are on the buy side and you want to go read those reports, I'm sure that those financial institutions will have reports for you, but it's good just to know if you're an investor that it's covered by these major institutions. And Canaccord, H.C. Wainwright, and Paradigm are major institutions that you would see following. This is kind of rare sometimes in the resource space because overall resource companies are kind of small when you compare them to a company like the tech giant. But to see a company that has this amount of coverage and those professional reports being written for the market is good. It means that you're more likely to get a supported share price, interest and liquidity in the stock, and so on and so forth, and available information about what's going on that'll hit the market. All right, so we're going to go to their corporate presentation. I'm going to walk you through this. Uranium Royalty Corp, their tagline is proven team, proven approach. I agree with them, and we're just going to walk through. Again, reminder about their tickers, UROY on the NASDAQ and URC under the Toronto Stock Exchange Venture. All right, so investment highlights, first chart. The first mover advantage. URC is the first company to apply the successful royalty and streaming business model to the uranium sector exclusively. It's not just that they have exposure to uranium, it's that they're focused on uranium. Focusing your attention on one sector is good. And when you have that management we went through that has experience, that's good. Strong balance sheet, so they can capitalize on additional royalty and streaming acquisition opportunities, so they can continue to be picky about what they want and add to it in an accretive fashion without taking on additional dilution or debt. Physical uranium ownership, they have 5.9% stake in London listed Yellowcake PLC, which hold interest in physical uranium. So they're buying uranium at the lows. So they also have exposure to the end product, not just the companies producing it, but to the end product. So as that uranium price rises, because that demand profile is very bullish, as I showed you, and the overall state of the uranium market at the beginning of this video, they're going to make money on the actual uranium itself, which is really cool. They've got direct exposure to the commodity. They include interest on 15 development, advanced, permitted, and past producing projects in multiple jurisdictions, MacArthur River, Cigar Lake Mines, and we were talking the big ones. And the management and board possess decades of uranium industry experience. So that's what you have there. Again, a slide in here for you on the board of directors and management. Excellent management team, not an issue there. They have a strategic partner in Uranium Energy Corp, as I stated, which Amir Adnani has been involved with for many years and which I have followed for several years looking at them as a potential investment since about 2018 and early 2019. Here's their capitalization. They only have about 72.2 million shares outstanding, which is not bad. If you consider the warrants, it's diluted about 99.7. The key shareholders are Uranium Energy Corp, Altius, Mega, Marin Katusa, KCR Fund, Rick Rule, Sprott Global, Commodity Capital, and Extract Capital. So when you see Rick Rule, Sprott Global, Marin Katusa, those are major names in the resource space, major names. If you want to know the biggest proponent of uranium probably on the planet, it may be Marin Katusa. Just go to one of his conferences or sign up for his newsletter. He puts out reports all the time on where uranium is going, and he believes he has the best companies to invest in the uranium space. And guess what? He's a major shareholder of this one. So those are major endorsements by people who know what they're doing, put millions and millions and millions of dollars down, and don't play games. They know how to prospect these companies. The market cap right now is 271 million. For those of you wanting the financial numbers, I'm trading on the NASDAQ at $3.01 as the time of this presentation, 375. I think it was a little bit higher when we actually looked at it earlier. So this is a little bit old. They've actually had a little bit of share price appreciation since this presentation was put out. They have 46 million in cash and securities, 7.5 million in shares in Yellow Cake PLC, which has that exposure to the physical uranium. So financially, they're pretty darn sound. They're not in any sort of dire straits. They've got liquidity. They've got exposure to the commodity. They can capitalize on a lot of these things. So going through, they want to do access to multiple countries. So we showed that chart on the state of the uranium market earlier in this video where I talked about where it comes from. They're in where it comes from, those major jurisdictions. So they're taking on projects that are in places where you're going to get the uranium. And that's what you want from a royalty company, because you want production and you want production over time. So that's their strategy. Range of market capitalization, near, medium, and long-term assets. That's what you want. They don't want you don't want to be invested in mines that are going to deplete quickly because that share price will fall. You want that steady stream of oncoming production and solid production. And that's where you get the benefits out of a royalty or a stream. Either way, invest across the cost curve and physical ownership. So they have all of those things. That's their diversified approach. These are the names that they're involved with: Uranium Energy Corp, Cameco, Orano, Rio Tinto, Yellow Cake PLC, CNNP, Paladin, Electricity de France, Energy Fuels, Peninsula Energy, Azarga, and Laramide Resources. So some major names there that people will recognize who are in the resource space. So again, strong partnerships, strong projects, checks the box. I'm just going right down and checking all the box on what you want to do. Now, if you're, again, a paid subscriber, Gold Silver Pros University, I'm checking all the boxes that I tell you to look for when you're prospecting for companies. This company checks the box, and that's why I'm bringing it to you today. I believe that this company checks all those boxes and is a positive potential investment for you. Now, you have to do your own due diligence and research. We're just a research firm here to educate you. But again, I do see a lot of those things that I look for. And I think if you do your own research, you'll see them as well. So they have a global diversified asset portfolio. You can see that here on this map. They're in the world-class Athabasca Basin royalties with MacArthur River. They have Cigar Lake Waterbury, Rough Rider. So you can see what they have and their different royalties and streams here. 1.7 NSR over here, 1% GOR on a 9% share, 20% MPI on 3.75% share. They give you all the details there. Continue Russell Lake, Diabase. So they're going through all that. They're going through all the properties here that they have. So they've got a wealth of properties in different areas. And this is really what you want. They go through the detail. I'm just going to fast forward through some of this. Really, really good profile. So why do you want to own a royalty company? Let's go back to what we were talking about earlier in the week. Because you're not exposed to the operational issues of the individual miners. You're basically taking a portion of their profits and exposure to what they produce, but you're stretching it across many providers. So you're not exposed to any individual providers, potential operational issues or jurisdictional issues. You're well diversified, but in that industry. And so Uranium Royalty Corp gives you exposure to the price, fixed operating costs, no development or sustaining capital costs, no dilution when they're funding a company. So they're non-dilutive to the actual mining company. So it helps all those mining companies get non-dilutive capital to help those mining companies raise funds, benefit their shareholders, and produce. So it's a win-win for both the mining company and for the royalty company. That's something I wanted to point out. A lot of times people are like, why would a mining company want to get They want to do a royalty or stream because it's non-dilutive financing in many cases, and it's more readily available funds. And the management of the royalty company can value it much easier than can a collection of analysts all over the place when they're trying to raise funds. And it's easier, quicker, and better sometimes to get that to fund your operations. Exploration and expansion upside without associated costs, meaning the way that you set up the royalty and stream is as they increase production, you get the benefit of that, but you're not paying the operation cost to do the drilling, the exploration of all these individual mining companies. Diversified asset portfolio and ability to grow without increased management. The great thing about these royalty companies, and Frank Holmes of US Global Investors has said this for years. We wrote together on Seeking Alpha. I followed him and I've talked to him at conferences. And he's a big proponent of royalty companies because you know, per employee, they make a lot of money because it doesn't take a lot of people to run this. It's basically a financing operation. It's not a mining operation. So they bring in the mining expertise, the exploration expertise on the team. They identify the good projects, but they just do the financing piece. So you don't have to have a large organization to do that. That's one of the advantages of having a royalty company there, is to have that small team have those larger profits. Those profits then can be passed on to shareholders. And that's why royalty companies over time often return more, in some cases, than individual miners, depending upon the miners that you're looking at. So they have a great strategy here. They had their own uranium market overview, which I'm just going to point a couple of things out. Nuclear power growth remains robust. There's 443 operable reactors worldwide, 54 additional units under construction, 54 new reactors connected since 2012, and a 2.6% compound annual growth rate. Nuclear growth expected 2027. And that comes from the global nuclear power industry. Now, I showed you the OECD report, which showed much more robust top-end potential growth in uranium all the way into 2040, uranium demand 2040. A couple of key points here. China announced it's likely to triple nuclear power capacity by 2030. India plans for 21 new power reactors by 2031. United Arab Emirates completed a reactor and 3 under construction and 4 more under consideration. UK updating their nuclear fleet to new advanced reactors that can produce more energy, therefore will need more uranium. Russia is building 36 reactors in China, India, Bangladesh, Turkey, Egypt, Iran, and so on and so forth, all over the place. Japan has 33 reactors, energy plan targeting 22% nuclear power. Nuclear deemed essential to the net zero target by 2050. So again, when you get to net zero carbon emissions, that's where nuclear comes in. Japan's right there. That's why I showed you in the OECD report the benefits of running nuclear and the reduction of carbon, and why policymakers are going to turn to uranium. And that's confirmed here in this report. Of course, the U.S. is completing 2 new reactors in Georgia, has maintained a 20% market share for 30 years, and so on and so forth. 32 new reactors demand expected as electricity demand grew 36% from 1989 to 2019. So again, a good reason to want to get into uranium. Reactor demand significantly exceeds primary production. Spot prices below production costs. Hedges falling off. 2020 demand expected 175 million pounds. 2021 production expected only 128. So that is a production gap or a supply deficit of about 47 million pounds. So if we go back to why the uranium price is going to rise, if we get back to, well, I don't have that chart up, but I showed you the chart where they had more demand than supply, and that's why this price is going to go up. Last time that happened, last time you had more demand than supply, it went up. And we're not talking about the issue with the Kamiko mine. We're just talking about more supply and demand here, more than supply and demand here. And look at what happened. We have the exact same setup. We now have more demand than supply. We're expecting this to continue to go up. So the uranium price is going to go up, make it more profitable. Again, that's confirmed in their presentation. Uranium spot price here, as you can see, peaked at 138. Financial crisis, $70. Now it's down at 28.78. It's going to go up. Okay, that's the spot daily. It's going to go up again. We showed you all the reasons for that in the previous presentation. Accelerated rebalancing, cuts exhaustion, reduction suspension, mine curtailments, depletion, all of that had been occurring. Now we're reversing that whole trend. We're reversing that supply depletion that we had. Beyond existing mines, Trade Tech's market appetite for new production, very bullish. Look at this from Trade Tech. Again, another confirming resource. The OECD, International Uranium, and now Trade Tech, both all saying the same thing. 3 confirming sources saying the same thing. Additional demand, expected price to rise. So we're doing our research here. We're not trying to build out a theory or give you the investment profile of something that could go either way. Everybody pretty much in this industry expects this to go up. And so that's why this royalty company was formed. And that's why it's been operating the last couple of years, acquiring assets, trying to build out that uranium capacity. And so that's what's happening. They don't have a lot of shares. They operate very financially efficient. They have exposure to the rising prices of uranium under these very safe agreements in which they don't get exposure to the actual potential operating issues that you may have at a mine, which is an advantage for royalty companies. And they're very profitable for the investors because a lot more of that income passes down into to the investors in terms of the valuation of the company, the share price, and potentially they'll do some distributions as well in terms of dividends. We'll see what happens there, but your royalty companies do very well. And so I expect a royalty company in a market like uranium, which is expected to increase, is going to do very well. And I think that outlines the investment profile for you and the potential of this company. Once again, we're going to show you what that company is. I'm going to go back to the ticker so that you guys can see that. It is Uranium Royalty Corp. Again, URC is the ticker on the Toronto Stock Exchange Venture. And on NASDAQ, it is UROY. I'm going to be taking a look at this one myself. I've been following uranium for a few years, waited to present it to you guys, even though a lot of you guys had just been pinging me constantly. I have a friend that pings me on Telegram on the phone all the time, who's one of my subscribers, is like, Rob, talk about uranium. I'm like, I'm not ready. I'm not ready. Well, now we have the fundamentals lining up. We have a good company, good management, good projects, okay, a good model in the royalty model. And in addition, we have a macro environment in which uranium price should be rising. So again, I wanted to bring you guys an investment opportunity. I've chosen them to sponsor us on the channel for that reason, because I believe in their story, and I wanted to bring that opportunity to you guys as well. That's going to wrap it up for today, guys. That is Uranium Story, and that is Uranium Company, in which I would opt to play the uranium story. Until next time, this is Rob Keens with goldsilverpros.com.
Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics. As we continue on our coverage in the silver market, and certainly an interesting time right now in particular as the COMEX May silver deliveries, first notice day is coming up tonight. And of course, we have the interesting action on the LBMA, where they revealed that last time silver squeeze went down, they were weeks away from running out of metal. Which certainly seems to be different than what many of the bullion bankers say. But to break it all down, joining me live on the line, not only the sharpest silver analyst in the Northern Hemisphere, but dominating the South as well, is Dave Kranzler of Investment Research Dynamics. Dave, welcome on in, and how are you doing tonight, sir?
Well, thanks for having me back on. I'm doing okay. There's probably people out there who would disagree that I'm one of the sharpest silver analysts in the northern and southern hemispheres, but I can say that I've studied it, researched it, invested in it, and traded it for quite some time, so I know a little bit about it.
Yeah, and plus anybody would say something so silly. I hear that's what they call a Keynesian treasury investor, and I don't know, at least as rumor goes. I don't know if they're real people anyway, so we'll leave them aside and talk to the legion of silver fans who are always interested to hear what Denver Dave is seeing. Golden Dave, actually, if we're going to be completely accurate about it. But in either case, with everything that's happened in the past 3 months, where do you see the situation with the deliveries? And we have seen metal leave the COMEX. Where do you think we stand?
It's a good question. One thing that I've learned over the last 20 years is that what's really going on at the wholesale level, when I say wholesale, I mean what the bullion banks are really doing, has been made intentionally opaque. And, every time they say they're going to reform their reporting, and make it more transparent, it becomes even more opaque. And the best example is when the LBMA restructured their fixed process and said they were going to make the data more readily available and more transparent, and they actually did just the opposite. So, all we can do is kind of guesstimate based on the indications that we're seeing in the marketplace. And obviously, starting last March, the situation with physical gold started to become very tight, and it looks like really since probably December, January. It looks like the silver situation has also become tight. And I mean, clearly the mints are on allocation, and there's a lot more silver demand, especially at the retail level, than there is supply right now. And that's why premiums are so wide. And that basically tells us that the mints have been somewhat cut off from supply, or at least enough supply to fulfill retail demand, because that silver is needed elsewhere to make physical deliveries to, you know, non-friendly buyers who won't be as patient as the retail market will be. So, yeah, I think there's generally at every level, there's probably a lot more demand than there is supply. And, you know, another signal that we're seeing is the intense effort right now in the paper market, the gold and silver derivative markets to hold down the price. And you know, one of the motives for them doing that is to try and discourage people from getting interested in investing in people and institutions from buying and investing in gold and silver. And what struck me this time around is that this manipulation in you know, via the derivative markets has been going on now for, you know, several weeks. And it just seems that it's antagonizing and pissing off the retail side anyway, at least, even more so. And there's even more resolve to try and, you know, create some type of short squeeze and expose the truth about what's really going on.
Yeah, and Dave, it's interesting because you mentioned how these institutions, they're set up and say that they're giving transparency and full information on the market, and then in reality, it's often quite the opposite. And I mean, geez, if the ones you mentioned are fit that pattern, I'm curious if you have heard the recent comments of CFTC Acting Commissioner Ralston Benham. This is the guy that on February 1st launched a silver manipulation investigation. Then on February 2nd, we had what I would call the biggest silver manipulation occurrence in the history of silver, which is not an easy title to wrest away. And then Benham gives these comments saying that, you know, the market structure really was tamped down what could have been a worse situation, and that, you know, they acted to control the price and volatility. Curious if you have any thoughts on that. I've never imagined I would hear a regulator say that in my entire financial career. I was stunned by it. Is there any other possible meaning that you could think of that might, is there any way you could explain those other than price capping, or what do you think about that?
I mean, yeah, I did. I mean, you've done a great job exposing these scoundrels and exposing Benham's comments there, and it really is kind of stunning, because it's really an overt admission that they're, you know, they manipulated the market. And when he says, you know, contain the volatility, well, markets by nature are volatile, and you need to let them be.